happen in oil markets based on publicly available knowledge and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world. And when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3, 4.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is, is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car.
Yes.
We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia. which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. Its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. Every other form of fossil fuel hydrogen, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
Hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. Blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. we had policies to support it 5, 10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and on Bloomberg Quick Take. It's Thursday. It's December 22nd. I'm Katie Greifeld, alongside Bloomberg Radio anchor Paul Sweeney. Again, both Carol Masser and Tim Stenevec are off today.
I didn't even think that was allowed.
I know, it's definitely
I don't know
not.
who's in charge of there.
Yeah, no, I'm gonna keep track of this. Hopefully they come back next week, but in the meantime, they're missing out on an ugly day in the markets. You have the Dow off by more than 2%, the NASDAQ 100 sinking lower as well. We're gonna get to the why in just a moment, but we're also gonna bring you the latest on Sam Bankman-Fried. He's back on U.S. soil after being extradited from the Bahamas last night. The latest is that he's going to be released on bail. We're talking about a $250 million bond. We're going to get to that in just a couple of minutes. We're also going to check in with one portfolio manager who isn't too pleased with Elon Musk's management of Tesla. Paul, I don't think he's alone.
No, and you talk to some of the bulls here, and there still are some. They're just so upset because the fundamentals are still pretty darn good. But it's just been the fallout over Elon Musk and his purchase of Twitter, and all that has brought over the Tesla shares. And that's really been the big driver.
And it's a story that keeps on giving. We're going to get into it. We're also going to chat about why the Federal Reserve probably doesn't care too much about the misery that investors, at least, are feeling. All of that ahead over the next 3 hours. But first, let's get a check in on the trading day with Doug Krisner.
Hey, Katie. Well, as you indicated, we've got a sell-off in the equity market. A lot of concern today about the quality of earnings, particularly given the fact that Micron's revenue was weaker than expected. And the company went on to say last night after the bell, it's going to cut headcount by about 10%. Shares in Micron right now slumping by 5%. And this news has really rekindled a lot of concern about weak demand for chips. The semiconductor equipment makers in particular are being very hard hit today. We've got the Philadelphia Semiconductor Index down by more than 5%. S&P 500 off about 2.7%. The Dow is down about 2.2%. And the NASDAQ composite weakening by about 3.4%. All of that a part of the weak tech story. And then there is the story on CarMax. The company's earnings coming in well below already depressed expectations. And needless to say, these results have deepened concern over weak U.S. used car markets. Prices have been crushed, volumes are cratering, and shares in CarMax right now cratering as well, down about 5%. Now, we should also point out, casting a pall over the market, bearish comments today from investor David Tepper. He told CNBC he's leaning short on equities next year because of the global tightening story, which then takes us to the day's economic news, pointing to resiliency and supporting this idea that the Fed is going to continue to tighten. First-time jobless claims up less than forecast last week, and the final reading on third-quarter GDP was revised higher. The yield on the two-year Treasury up about 3 basis points now at 4.24. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, thank you so much, Doug Krisner. Now let's get to the market drivers report and set the business week agenda. Here to help us do that is Bloomberg News markets correspondent Abigail Doolittle here with us in studio. And Abigail, I look across the screen, seeing a lot of red. It doesn't seem like there's any havens out there. What is driving this?
Yeah, it is a lot of red, Katie, and somehow it feels surprising. Even though we've been in this downtrend, we had yesterday a pretty decent rally for stocks. It was 2 up days for the S&P 500. And here we now have the S&P 500 down 2.8%. Its worst day either since October 11th or September 13th, I believe, depending, or October 7th, actually, depending on how low it is. But it's right across the board, to your point, for all these different indexes. The tech-heavy NASDAQ is down 3.8%. The New York Bank Index down 5.3%. And then the SOX, and I think that's the epicenter of today's sell-off, is down 5.7%. Before talking about the SOX very quickly, though, there was some eco data that came out decent. Jobless claims came in a little better than expected. I don't think that that really moves the needle all that much. And then you also had GDP revised higher on its third revision. So maybe the idea that folks are nervous that the Fed is actually going to do what they're going to say that they're doing, and that is hike. However, you have yields basically up a little bit in the dollar. So I think it's the chips. Micron put up a messy quarter, their first loss in many, many years. The outlook, not great. This is a boom and bust industry. Chips, very important for everything, and it's clearly we're in the bust part of it. And I think people are nervous that we're going into, the bust will carry right into 2023.
And, the volume, it's not one of those days. I thought we'd have a really, really sleepy day in terms of volume. The volume's kind of hanging in there relative to the historical average.
Yeah.
Even on NASDAQ, it's a little bit higher than the recent 30 days. So there are traders out there. There are people making some bets here. And right here, it's a little bit of the good economic news. It's not so good for the stock market in terms of the Fed.
Yeah, there's a little bit of that. And, to your point on volume, so this is an interesting thing. Volume has been so anemic recently. So even though it's hanging on there today, it's relative to, really bad volume. So if we were to compare today's volume to, say, like September, October, I'm guessing it would still look pretty anemic. But yes, there are some traders who really are selling. We're looking at a third down week for stocks. Investors really just trying to figure out what to make of all this.
Should I say Santa rally? Should we talk about that? When does that kick in?
So that kicks in, I believe, technically it kicks in next Tuesday or Wednesday, and then it's the first 2 trading days, I believe, of January as well. You know, it's interesting because a lot of people have talked about this maybe being similar to 2018, and if you recall, 2018, there was that massive sell-off in the fourth quarter, and then, capitulating in some ways on Christmas Eve. You know, if we have that today and tomorrow, who knows? Next week, maybe we'll have a rally. But what would be the why? You know, I had Ari Wald yesterday on Options Insight. He made a really interesting point relative to the S&P 500, which the S&P 500 is testing the support right around the gap made on November's CPI report. That really provided some good news. The SOX is trying to do that now. So let's see whether or not these indexes can hang in where those sorts of levels. If so, there may be reason to think that maybe we get a little bit of a pop. I think the message here at very best is we have this messy sideways market, but I'm not sure that it's going to be like the crash that some folks are talking about.
Well, it's interesting. This is the time of year when we all speak to strategists and fund managers and get their 2023 outlook. It seems like it's split right down the middle. For every bear I can find someone who's a little bit bullish, particularly in the back half of the year. But I don't think anybody's got any real consensus call here right now. I guess it just simply depends in large part on the Federal Reserve.
I think that is the critical driver for sure. The Federal Reserve, the other central banks, the Federal Reserve getting help from the other central banks. I think it's hard to have a consensus right now because there's still so much uncertainty. Folks are talking about the recession next year. How bad will it be? How much of it is priced in? If we take a look at valuation, you could make the case that it's a little bit high, that maybe stocks do have to come in. But yes, at the end of the day, it's going to be that Fed. And you know what? It just stands out to me still, in WIRP, the terminal rate is 4.5%. The Fed's talking about something above 5%. Markets aren't believing the Fed. I think I said this earlier in the morning, if I had to put my money on the bond traders that have been horribly wrong this year or the Fed who's really driving the bus, my money would be on the Fed.
Is there any bullish case to be made for next year? I know that it doesn't seem like there's a clear consensus. The consensus I can find, though, is that there's going to be a recession. You can quibble over, the magnitude, the depth of that. But when you look at past recessionary periods, what typically happens at the big benchmark level?
Great questions, Katie. So I think the way that I want to think about this question is looking back on prior market periods. So 2000 to 2003, it was a pretty brutal bear market. The S&P 500 dropped almost 60%. There was one little recession in there. It was in the fourth quarter of 2001, and it was only on the corporate level. It wasn't even consumers. So there wasn't even a real recession, but because things had been so frothy and over the top, you had this long rolling bear market. I would say here, that would be the best case scenario, that the recession is not going to be fully driven by the consumer, which is 2/3 of GDP. It will be more on the corporate level. If that's the case, maybe it's not going to be quite as bad. And then I think the Federal Reserve, is really interesting. It was just really interesting what happened the other day with the BOJ in terms of them finally joining the hawkish bandwagon, giving the Federal Reserve some leeway. If the dollar declines, and technically it looks like it will, as they raise rates, that could be an optimal backdrop for stocks to at least hang in there.
All right, Abigail Doolittle, great to check in with you on a really ugly day for the market. Again, the S&P 500 off by about 2.7%. That is Bloomberg News markets correspondent Abigail Doolittle.
Bloomberg Business Week is brought to you by Innovation Refunds. Are you looking for ways to grow your business? Get back the money that you may be eligible to receive through the Employee Retention Credit. Sign up before it's too late. See if your business qualifies for ERC assistance at getrefunds.com.
All right, if I look at the Bloomberg terminal right now, the headline right on top is Sam Bankman-Fried released on $250 million bond in FTX fraud case. Let's check in with someone on the ground. We have Ava Benny Morrison on the phone from the Southern District Court of New York in New York City. Ava, we're going to get to the bail package in just a minute, but tell us a little bit about the scene on the ground.
Good afternoon. So at the moment, we're waiting outside the front doors of the Southern District of New York District Courthouse in downtown Manhattan. There's dozens of photographers, of cameramen, a lot of reporters all waiting for Sam Bankman-Fried to walk out. In the last hour, he's been granted bail. It was a very, very stringent bail package, and he was told by the judge that he'll be able to walk out of court today once he and his parents sign the paperwork.
Ava, was there a plea entered today?
No, there wasn't a plea entered today. It was the first time that he had appeared in court on the US charges, and the court heard that he'll have a chance to enter a plea at a later date. The next court date is set down for January.
So this must be some house the parents have. It secures a $250 million bond. Can you explain how that works?
Well, it's not so much the worth of the house, but it is that he will be on the hook and his parents will be on the hook for $250 million if he breaches any of these bail conditions. Now, there are 15 bail conditions. He's essentially going to have to live in home detention with electronic monitoring in his parents' house in California. And they've used their house as a surety attached to the bond. So again, if he tries to flee, if he breaches any of these conditions and a warrant is put out for his arrest, the judge warned him actually today that he will be, he will have to pay $250 million. And I'll make the point as well that the prosecutor said that this was the largest pretrial bond in history.
Wow.
Wow. So, Ava, I mean, you've been covering this story every step of the way, and it's just a whirlwind. I mean, it was just 10 days ago on December 12th that Sam Bankman-Fried was arrested in the Bahamas, and 10 days ago, we thought that he was going to fight extradition. Walk us through how we got there, how we ended up here at this New York court appearance today.
You're very right. It has been a wild ride over the past 10 days. Bankman-Fried has been living in the Bahamas for some time, and it was last Monday evening that the Bahamian authorities, acting on a provisional arrest warrant from the US, arrested Bankman-Fried. He was accused of orchestrating a years-long fraud through FTX and FTX's hedge fund arm, Alameda Research. He appeared in court in the Bahamas, and he was denied bail. And initially, he indicated that he would fight extradition to the US. But I think there was maybe a bit of an assumption that he would be granted bail and he would be able to move back into his apartment in the Bahamas and fight extradition from there. But he was taken to quite a notorious prison in the Bahamas where he has been for where he was for more than a week. Then he changed his mind over the weekend and decided that he was going to consent to extradition back to the United States. And that played in his favour in the bail hearing today. The prosecutor said that if he hadn't had consented to coming back to the United States, then he may not have been getting bail today. He was flown back from the Bahamas to White Plains, north of Manhattan, last night. He was escorted by FBI agents and then appeared for the first time in court today.
And another major announcement regarding this case is former Alameda Chief Executive Officer Caroline Ellison and former FTX Chief Technology Officer Gary Wang. They pleaded guilty to fraud and were cooperating with the prosecution. Boy, I didn't see that coming. Give us kind of what we know now.
I think there was a lot of rumor and speculation about who from FTX was cooperating or wasn't cooperating. Bankman-Fried had been very vocal about what happened at FTX or his version of events ever since it all collapsed early last month. He was doing a lot of media interviews, but his co-executives and the people that are closest to him were noticeably quiet. And the timing on this announcement about about Caroline Ellison and Gary Wang pleading guilty was really interesting. The prosecutors here in New York waited until he was on the plane in the custody of US law enforcement and on his way to New York before they announced that Caroline Ellison and Gary Wang, who had been with Bankman-Fried from the very early stages of FTX, had actually been cooperating with them. And they had both pleaded guilty to fraud charges. Ellison has pleaded guilty to 7 charges. Wang has pleaded guilty to 4. And they have agreed to cooperate with prosecutors. This is obviously a massive blow for Bankman-Fried, and they will be really, really valuable for the prosecution case.
Well, that's what I've been wondering, what this means for Bankman-Fried's defense, because, I mean, during his media tour, he was very clear that it wasn't necessarily intentional. It was management missteps. That at least is what he was trying to present. But now that you have these two very inner circle people, I don't know how much more inner circle you can get, pleading guilty, cooperating. I mean, what does that mean for Bankman-Fried?
Exactly. And during his media interviews before his arrest, he was attempting to shift the blame a little bit to Alameda and saying that he didn't have as much oversight over Alameda as he should have, and he wasn't quite sure what was going on there, because one of the key issues of this case, obviously, is the use of FTX customer funds to place high-risk bets and prop up Alameda. And so he was attempting to sort of put that hedge fund house at arm's length. And we sort of got maybe a little bit of a preview of the argument he might put up at a future court case. But Gary Wang, I think, will be a difficult witness to get around. He lived with Bankman-Fried in the Bahamas. He was the chief technology officer of FTX. He wrote the codes that helped establish FTX. He was, by all accounts, working side by side with him. So it might be a difficult argument for Bankman-Fried to make that he didn't know what Wang was up to when Wang has admitted to engaging in fraud.
So we only have about 20 seconds left with you, but I am curious, what should we be watching for next? What's next in the timeline?
Well, we're waiting now for Bankman-Fried to walk out of the courthouse. His parents, Barbara and Joseph, two Stanford Law professors, were here in court. We're waiting for them all to walk out, and then he will have to make his way back to California. So I guess we're watching to see, A, if he abides by those bail conditions, but also who else prosecutors have their eye on.
All right, great stuff. That is Ava Benny Morrison on the phone outside the Southern District Court of New York in New York City, giving us all the latest on Sam Bankman-Fried and that FTX fraud case. Definitely a lot of moving parts here.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We're seeing a sell-off in the equity market right now, and the major indices near their session lows. A lot of concern not only about an earnings recession, but the effect of further Fed tightening. Let's begin with a story on Micron Technology. After the bell last night, the company's revenue forecast for the current quarter came in weaker than expected, and then the company went on to say it's going to cut headcount by about 10%. So this news has rekindled a lot of concern about weak demand for computer chips. Today, we're looking at many of the semiconductor equipment makers leading the way lower. They are the biggest decliners within the Philadelphia Semiconductor Index. The overall index right now is down by well more than 5%. And then on top of that, the day's economic news supports this idea that the Fed can continue to tighten. First-time jobless claims rising less than forecast last week, and the final reading on third quarter GDP was revised higher. So if you look at the yield now on the two-year Treasury, we are up more than 3 basis points to 424. Back to the equities, we've got the Dow down more than 2%, the S&P 500 off by more than 2.5%, and the NASDAQ composite weaker by 3.3%. A Senate committee is looking at whether automakers are using parts and materials made with forced labor from China's Xinjiang region. Dow Jones saying that 8 car manufacturers have been asked to provide detailed information on their supply chains. Now, the U.S. bans most imports from Xinjiang under the Uyghur Forced Labor Prevention Act. And we're looking at weakness not only in shares of companies like Tesla, but GM as well. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right. Thank you so much, Doug Krisner. Paul Sweeney, do you have a mantra that you use to stay out of trouble?
Yes, I do, and I've shared it, and I share it continuously with my 4 children, which is trust your gut. If it just feels wrong, it probably is wrong.
I like that.
Yeah,
I have one too. I'm not
work.
going to say it on air though. But you know what's interesting is that Brian Moynihan also has a mantra. I know that because I'm looking.
Working too.
It does. We're going to get into the why with Catherine Doherty. She is a Bloomberg News finance reporter. She has a great article in the latest issue of Bloomberg Business Week. Brian Moynihan has a mantra. He repeats to stay out of trouble. Catherine, what is that mantra?
Responsible growth. If you have heard anything about this bank or heard Moynihan speak, or really any executive at the bank speak in public, it's almost impossible not to hear them utter those 2 words, that phrase. And it really started post-financial crisis when the bank was trying to rebuild itself. But it's taken on an entirely new meaning today because they're past that rebuilding. Now they're in the growth phase. And the big question becomes, how do they go past that growth stage and really remain stable if we're going into what looks like a very rocky economic environment next year?
And so, Kat, I guess, that responsible growth, that makes a lot of sense. But maybe a detractor might say, by eschewing risk maybe in some of your businesses, you're giving up some potential returns there. Does you ever get any pushback that maybe the bank doesn't take more risk, maybe even more responsible risk?
So it really depends on who you're talking to. Within businesses like the investment bank, yes, I have spoken with many folks who say that missing out on deals can be frustrating, especially on Wall Street when it's such a cutthroat environment and you're looking to one-up someone across the, per se, street. And so when you're having to think about what to either accept or pass on, the bank is very intentional about which clients they're taking in. So that could be, again, investment banking, it could be trading, but the bank goes beyond those businesses. It's, one of the largest consumer lending arms, and if not the largest small business lending arms as well. So they have clients that extend beyond just traditional Wall Street. Now, Moynihan, when I spoke with him about this to kind of get to the heart of it, he says it's not just about market share. Market share is what you hear a lot of folks discuss when talking about the big banks on Wall Street. He's saying what's more important is if it's profitable, if that market share can stick, and if the customers can stick, because if they do and they stay with the bank, then the growth happens, hence the responsible growth.
Okay, I get it now. All right. So they've missed out on some deals, Bank of America, but talk to us more about the responsible part. I mean, what kind of messes have they avoided as a product of this mantra?
So pretty recently, beginning of last year, when Russia invaded Ukraine in February, we saw banks who were reporting on Goldman, JP Morgan, they were helping their clients trade Russian debt. And Moynihan made calls specifically to his senior credit trading executives. And he said, I don't want us engaging in this. In fact, I want us to be as far removed as we can. So if we are in some way involved, get us out. And if we're not, don't get into it. So even though there were some banks that were making money on these trades, Bank of America said, we don't want to be getting involved in both this political and financial, what could be a mess. That was a bet that they were making. And also when you think about situations specifically, in my story, we talk a little bit about Archegos and how so many of those banks were caught in what became billions of dollars that they were responsible for and lost. Bank of America was approached by Bill Huang and his team, and they passed on this deal. So they avoided billions of dollars lost. But it's not all, they haven't missed every single blow up. Specifically, they were caught in Steinhoff, the mattress company, which was a Ponzi scheme, evidently. And so that one they did lose money on. And even more recently, there's been so many leveraged finance deals that we've been reporting on, companies that are bringing debt to the market at one price. And as the market has changed, the banks are having to keep this debt on their balance sheet that they normally are able to sell off. Bank of America is also involved, and they're not immune to this changing economic environment.
Well, I look at the holders list, the shareholders list, and one big believer in the strategy is Warren Buffett. That's a pretty good shareholder to have.
Yeah, it was a huge news when he became a shareholder, and I believe it was 2007 that is the first time he bought shares, and 2010 was one of the big years that he doubled down. Now he's the biggest shareholder, and he's been a big believer in Moynihan specifically, and I think part of his belief is how Moynihan dealt with really what he was handed when he became CEO, which was rebuilding this bank and getting it out of the financial crisis. Moynihan was a lawyer by training, and he really used that to help the bank move forward. He spread out billions of dollars of legal payments that they needed to make and were responsible for previous actions before the crisis and going into the crisis. And because he was able to do that and deal with it methodically, the bank didn't go bankrupt. Obviously, we had the bailouts, but they were able to continue and be profitable and chip away at those payments over time. And Buffett saw that, and he was the first person to come forward and say, I see this as a strategy that is sustainable, that I believe in, and that I think is going to end up putting the bank on a stronger foot going forward.
So, Kat, Mr. Moynihan keeps a lower profile than, say, Jamie Dimon of JP Morgan. That's why I was really surprised to see Mr. Moynihan at the December 1st state dinner for French President Emmanuel Macron. I was surprised to see him there. I mean, what did people make out of that?
He's really raised his profile. I've gotten many comments from people saying, is he on TV or on radio and making tours more often? And I would say yes. You can tell that he's become much more confident in the way that he carries himself. Not that he hasn't done public speaking the whole time. I just think that he is doing it more often. And with regards to the White House, I have folks telling me he is Biden's go-to president to talk about the economy. And that is part of the reason he was part of this group at the state dinner in December. But it was very unique. He was the only Wall Street CEO there. And that caused some speculation that maybe the White House is looking at him for some sort of role in the future, although he has indicated he has no intention of leaving his position. He says, he's just told me, quote, this is the greatest job in the world. He acknowledges that it's the board's decision to keep him on, but he has no intention of leaving.
The greatest job in the world. Wow, the mind runs wild. But let's talk a little bit about the economy. You brought that up, that, that's a discussion that those two have. And I can see how sort of leaving money on the table in boom times would be frustrating to shareholders. But this responsible growth approach, how does that look as we're heading into maybe a recession? We have about 40 seconds left.
Well, it really means the clients. Back to Moynihan's earlier comment, it's the clients that stick. So in a recession, if you have the clients and they're not fleeing, obviously they may not be in a healthier position. But if you have built the house with stronger foundation, hopefully you're able to weather the storm.
All right. It's a great piece by Bloomberg News finance reporter Catherine Doherty. The headline
Bloomberg
there.
Business Week magazine.
Yeah, the
How
latest
cool is that?
issues. You can go out and get it, hold it physically. You don't have to just listen to us. That is Brian Moynihan has a mantra he repeats to stay out of trouble. I don't know if responsible growth exactly rolls off the tongue.
Yeah, it's not very catchy.
It's
but
no
I get
trust
it.
your gut necessarily.
Yeah, like trust your
gut. But it's a great piece. And Moynihan obviously is a fixture at Bank of America, even though necessarily he wasn't the first choice or not the natural choice.
Came from consumer banking, not a big banker or big trader or something like that, a big investment banker, but the consumer bank has been and continues to be a real strength of that bank.
There you go. Well, we are just getting started here on Bloomberg Business Week. We're going to count you down to the close coming up soon. Much more to come.
All right, let's get a check on the latest world and national news. We do that with Wendy Gillette in our Bloomberg 1130 newsroom.
Thank you very much. The Senate has just passed a $1.7 trillion spending package that averts a partial government shutdown. A judge is allowing cryptocurrency executive Sam Bankman-Fried to post a $250 million bond and live with his parents in California while awaiting trial for allegedly defrauding investors in his company, FTX. The district court judge in Manhattan said the entrepreneur perpetrated a fraud of epic proportions. That $250 million bond is believed to be the biggest federal pre-trial bond ever set. Afghan men are standing in solidarity with women forced out of higher education by the Taliban. Bloomberg's Steve Rappaport has the story.
More than a dozen male university teachers quit, and several male students walked out of class to protest the latest blow to women's rights under Taliban rule. The regime this week announced a decree banning women from higher education and wasted no time enforcing it. A female student on Wednesday said armed Taliban members blocked women from entering a campus in Kabul. Some women and girls protested in the capital today. Local media reported Taliban soldiers beat them with sticks and whips. The Taliban pledged to form a moderate, inclusive government after reclaiming power last year, but quickly returned to its repressive ways. Steve Rappaport, Bloomberg Radio.
Nancy Pelosi gave her final briefing as House Speaker.
The best advice I ever had that I extend to you is be yourself. You're the only person in the history of the world who is you. What you have is authentic, is special, is unique, and that diversity is necessary at the table.
The House Speaker also reflected on the changes in diversity since she entered Congress in 1987. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market is down at the moment. We are off session lows, but there has been a lot of selling throughout the day on concern about an earnings recession and the negative impact on stocks when it comes to further Fed tightening. And then there's the story on Micron Technology with revenue forecast at the weak side of estimates, and then the company saying that it's going to reduce headcount by about 10%. So we're seeing a lot of weakness today in semiconductor-related issues on concern about slowing demand for chips. The Philadelphia Semiconductor Index right now is down by more than 5%. And generally speaking, a lot of weakness showing up in information technology. Almost couldn't get it out there for a moment. And that is leading the way lower for the S&P, which is down about 2.3%. The Dow falling 1.8%, and the tech weakness helping to send the NASDAQ composite down about 3% right now. And then when you look at the day's economic news, it kind of supports this idea that the Fed can continue to tighten. First-time jobless claims up last week more than expected, and the final reading on third-quarter GDP revised higher. Two-year Treasury is up 4 basis points now at 4.25. We were talking a short while ago about the Senate passing the government funding bill worth $1.7 trillion. Economists at Goldman were saying that's a little ahead of what the firm had been forecasting, and it now boosts the chance that the federal government spending will have a positive impact on economic growth in the states next year. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. We appreciate this. Well, how about this for an uplifting title here? Federal Reserve doesn't care about misery investors are feeling. And then I read along, supporting stock and bond markets, that's not the business of the Federal Reserve. As I read those two things, I said, this feels and sounds like a Michael Regan, piece of writing. And sure enough, that's what it is. Joel Weber, editor of Bloomberg Business Week, joins us here in our Bloomberg Interactive Broker Studio. And he said Mike Regan, senior editor for Bloomberg Markets, joins us on Zoom from New Jersey with his Maryland Terps sweatshirt, it looks like. There we go. All right, Maryland football. Are they bowling?
Yeah, Maryland has a football team.
They are, yeah. The Duke's Mayonnaise Bowl, which we all know is the most important bowl in college football.
Sounds sticky.
Exactly. All right, Joel, talk to us about kind of what we're doing here with this column here. The Federal Reserve's not in the business of supporting stocks and bonds.
Yeah, when we're talking about the year that's been, one of the themes has just been how, for a long time, it felt like there was a punch bowl and the Fed was there to host a great fun party and everything always went up. And then all of a sudden that punch bowl was taken away and some carnage ensued. And obviously inflation being a huge theme of the year and the Fed continuing to raise rates and any sort of accommodation that once may have felt like it came from the Fed is nowhere to be seen. And in fact, Jay Powell might look a little bit like a certain, movie poster from the movie Misery or something, right? Right, Mike? That was where we went with the art in this one.
Yeah, pretty much. It's interesting in that, you can have this economy that on the surface is sort of booming. We got that GDP print this morning, 3.2%. We've got a unemployment rate that's 3.7%, near a 50-some year low. But if the inflation picks up like it has this year, it's an economic emergency, basically, that the Fed has to fight because, inflation really can cause maybe less pain, less misery than unemployment per person that it affects, but it affects everyone, right? A broader swath of the population. So I went back to this, one of my favorite indexes, the Misery Index, it's called. Arthur Oken, who was a advisor to LBJ, President Lyndon Johnson in the 60s. And I love it because the math in it's very simple. It's just the unemployment rate plus the inflation rate. And the idea being, if either one's elevated, you've got problems in the economy. And in this case, it's the inflation that's elevated. So as you put out, Joel, the markets got used to this, the Fed that would always come to the rescue if the stock market or even the bond market was looking wobbly and headed towards a bear market or a big drop. And I think it was a tough lesson for investors to learn this year that it's not the case this time. That it's really this inflation is causing so much misery for so many people that they're willing to really just allow the markets to create this pain for investors this year. So a lot of misery to go around.
I gotta say, my personal misery index has a few more components than just those two, but it's a pretty good.
Give me what's the next one?
Oh, it depends heavily on the weather, but
okay.
In any case,
bomb cyclone. Yeah.
yeah, it's going to be disgusting tomorrow. But Mike, I do want to push back a little bit on the headline. So the Fed doesn't care about the misery investors are feeling, but if you look from the perspective of financial conditions, in some way they do care, and they actually like it when you think about what they're trying to accomplish. Fight with me a little bit.
Yeah, right. No, I mean, you're absolutely right. I would never fight with you, Katie.
Thank you.
I was going to say, he's just going to throw me under the bus there.
Yeah.
Well, Joel put that in there.
Well, that's the thing. The financial conditions are exactly the one tool that the Fed has at its disposal. And the way, the remote control for that tool is interest rates. So if, unemployment is their concern, if inflation is not an issue, as it wasn't really an issue for how long there, from basically since the global financial crisis in 2008 all the way up until COVID. There was no real worry about the inflation from Fed, so they really were focused on that other side of their mandate, the employment situation, and trying to make sure the economy was at full employment. So if you can keep rates low to keep financial conditions accommodative to the economy, that's what they did for so long. It kind of lulled the market into thinking, the Fed has this unspoken third mandate to really prop up the stock and bond markets.
Well, and doesn't it feel just like the markets, like that third rail is like, if you're in the markets, that's what you really do want. All year it felt like that. It was just like, at some point here, the Fed's going to cave and it's all going to go our way, and we'll be ready for that moment. And yet, that moment simply has not happened this year, and if we look ahead, probably not going to happen for a while still.
Yeah, I would think. I would guess at least not until, and not in the first half of the year for sure. Maybe towards the back half of the year, we'll start getting some hints and some clues. But yeah, and to Katie's point, I mean, now they're using that tool of financial conditions for the opposite purpose, to really cool off the economy to some degree, to cool off the job market and inflation. So it's what they've always said that they do. They haven't made it much of a secret or much of a mystery, but investors sort of hear what they want to hear, I think. And so this is the year where it was kind of a reality check for markets, I think. And it's sort of the point of this column is that, to go back to Arthur Okun and his delightfully simple index, that's it. The job market and inflation are, to him, as far as how do you gauge sort of whether the nation is miserable or not, and to the Fed to fulfill their mandates from Congress, those are the two inputs they look at. So, if it's the unemployment rate that's causing the misery, they're going to err on the side of being too accommodative to financial conditions and actually will prop up the stock market and the bond market to some degree.
Right.
If, though, it's inflation like we saw this year, they're turning that knob the other way and tightening financial conditions to make sure that, the job market doesn't get too hot, wage growth doesn't get too hot, and feed into that inflation problem by forcing companies to raise prices to cover these higher wages. So, and I think you're right, Joel, that it doesn't seem like they'll be turning that knob back the other direction, at least not in the foreseeable future. Again, maybe they'll start hinting at it later in 2023.
All right, great stuff. Mike Regan, senior editor for Bloomberg Markets, joining us on Zoom from New Jersey, donning his Maryland Terps pullover there. Good stuff. Joel Weber, editor, Bloomberg Business Week, here in our Bloomberg Interactive Broker Studio. Good stuff there. And Katie, looking at the markets here, there's a misery index. If it's out there, people are going to be feeling pretty miserable today.
Oh, it's ugly. You're looking at the S&P 500. It's off by about 2.2%. That's off the worst levels of the session, but not too pretty, Paul. And that's the case across the big indexes right now.
Yeah, we'll keep up with that. We had some pretty decent economic data this morning, not terrible. So maybe that means the Fed can continue to raise rates to keep it a little bit of coolness out there. We'll have to keep up with that market. This is Bloomberg.
It's 2:53 on Wall Street. I'm Doug Krisner in the Bloomberg Newsroom with a look at some of the company headlines we're tracking at this hour. An energy storage company backed by Bill Gates' Breakthrough Energy Ventures is now planning a factory in West Virginia. Construction is expected to begin next year at a cost of around $760 million. Manufacturing is expected to begin in 2024. The parent company of TikTok, China's ByteDance, has found that some TikTok employees inappropriately gained access to data on some American users. This is certainly going to complicate an already fraught plan by TikTok to convince U.S. lawmakers that its app is secure. A Senate committee is looking whether U.S. automakers are using parts and materials made with forced labor from China's Xinjiang region. Dow Jones saying that 8 car manufacturers are being asked to provide detailed information on their supply chain. By the way, the U.S. bans most imports from Xinjiang under the Uyghur Forced Labor Prevention Act. The earnings from CarMax came in below already depressed expectations. These results deepen concern over weakening U.S. used car sales. Prices have been crushed recently and volumes have cratered. AMC Entertainment wants to convert preferred equity units into common shares, one of the reasons the stock is sagging today. And AMC is also proposing a reverse 10-for-1 stock split. And Scott Minerd has died. He was the CIO of Guggenheim Partners, regarded as one of the giants in the bond market. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, let's get a check on the latest world and national news with Wendy Gillette in the Bloomberg 1130 newsroom.
Hi there. The Senate has passed a $1.7 trillion spending package that keeps the government humming until September and averts a partial government shutdown set to take effect midnight Friday. Bloomberg's Amy Morris reports on what held up passage.
Leaders had planned to pass the measure last night, but got bogged down in a fight over amendment votes, especially one over immigration restrictions. Republican Senator Mike Lee's amendment to bar officials from ending Title 42 pandemic immigration restrictions was a key sticking point as negotiations on a time agreement fell apart. Lawmakers included more than 7,000 earmarks totaling more than $15 billion, with projects included for police equipment, highway infrastructure projects, and museums. In Washington, I'm Amy Morris, Bloomberg Radio.
The bill now goes to the House before it heads to President Biden's desk for his signature. The president is warning Americans to take seriously the winter storm affecting much of the country just before the holiday weekend.
Take this storm extremely seriously. And I don't know whether your bosses will let you, but if you all have travel plans, leave now. Not a joke. I'm sending my staff, if they had plans to leave on tomorrow, it's late tonight or tomorrow, I'm telling them to leave now.
The president got a briefing from FEMA and the National Weather Service, which is calling this storm a once-in-a-generation event. What's believed to be the biggest federal pretrial bond ever will allow cryptocurrency executive Sam Bankman-Fried out of jail as he awaits trial. He's accused of defrauding investors in his company FTX. A judge set bond at $250 million. The U.S. population grew by 1.2 million people this year, with international migration fueling the increase. Over 333 million people now live in the U.S., according to the Census Bureau. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette.
All right, Wendy, thank you so much. We appreciate that. Bloomberg Business Week is brought to you by Innovation Refunds. Small businesses impacted by the COVID-19 pandemic may qualify for the Employee Retention Credit. Let Innovation Refunds do the work to find out if your organization qualifies for ERC assistance. They've already helped businesses claim over $2 billion in payroll tax refunds. Learn more at getrefunds.com. All right. Are you traveling for the holidays, Katie?
You know I'm trying to. I'm supposed to fly out to Florida tomorrow afternoon. You know, I've been thinking about it for approximately 2 months now. I don't know if it's going to happen.
I mean, this storm is for real, and obviously we've been reporting on it all day. It started, off the West Coast and then dumped a ton of rain and snow on the West Coast, moving inland, and then the temperatures just dropped incredibly across the upper Midwest, and seeing some video of just brutal parts of the upper Midwest. And it goes all the way down to Texas.
Yeah.
And so we're talking about, there's a good article in the Bloomberg Terminal, cold blast threatens to kill U.S. wheat crops, freeze cattle as far south as Texas. So this is no joke across the entire swath of the country.
Even in Florida, where I'm going, I mean, the temperatures are expected to be 50s and 60s. So it's not New York, but it's not typical Florida. And if you're looking at FlightAware, apparently over 2,200 flights have already been scrubbed. The majority of Thursday's cancellations were in Chicago and in Denver. Travel disruptions, of course, are expected to strike LaGuardia as well. 158 Friday flights have already been scrapped, Paul. This is not good news for me.
This is not good news. And here in our New York area, just locally, temperatures are going to go up into the 50s and started raining already. It's going to rain most of tomorrow. And then the cold temp tomorrow night is back down to 10. So we're going to go from the 50s to 10.
Yeah, Merry Christmas.
Merry Christmas. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close with 60 minutes left in the trading session. Kriti Gupta, Shonali Basak. We are joined now by our colleagues Katie Greifeld and Paul Sweeney. We welcome to our full Bloomberg audiences across the world, across television, radio, and YouTube as well. It's a fascinating day in the markets because everyone is heading out, they're heading home, they're liquidating, they're getting out of the stock market, they're getting out of the bond market. Katie, why are we still at work?
Oh my God. Well, we were just talking about it, Paul and I. In terms of heading home, I'm supposed to fly out of here tomorrow. I don't know if that's going to happen, but to that point, there are a lot of people heading out of the stock market. You're looking at the S&P 500 off the worst levels of the session, but still down about 2% on the day, Paul. Not so merry.
No, and then if you look at the tech-heavy NASDAQ, I'm looking at that off 2.7%, and even more so, the NASDAQ 100 off more than 3%. So some selling and some selling to the high beta stocks that we're seeing in the NASDAQ.
Well, let's put some numbers on that selling pressure. The S&P 500 down 2% on the day. Take a look at the Dow Jones, though. We do like to look at that down about 1.5% as well. The NASDAQ, though, really taking it on the chin, to Paul's point, down about 2.8%. But I got to say, the movement in the Russell, I think, is really interesting because it's down about 2% and it's almost moving in tandem with the NASDAQ. When you see that big cap and small cap on the same page, that means there's a momentum trade at play, Shonali.
Yeah, let's talk about momentum because if you take a look at the sectors in the S&P 500, you are looking at every major sector here in the red, and the momentum here is certainly to the downside with infotech down more than 3%, consumer discretionary led down more than 3%, energy even, the favorite of the year, down more than 2.6%. Nothing is in the clear. Let's look at some of the individual movers here. There's a little bit of green on the screen. You have FedEx up the most in the S&P on the day at 1.6%. Remember, this is the second day of gains for FedEx after reporting very positive earnings relative to expectations and potential to really keep a handle on costs here. But take a look at the downside because some of the biggest decliners, Lam Research here, the reason that's a big deal, it is tied to the semi industry. Almost 9% decline. That is beating by almost double the percentage decline you're seeing over at Micron, which of course had negative earnings, really outlooks here yesterday for the street. Tesla down 9.3%. We've been talking about that pretty little discount they have been giving customers to boost deliveries as they struggle with demand.
And certainly something we talk about when we talk about kind of marrying the micro with the macro is the volatility at play. We're looking at a VIX with a handle of 22, Katie. And I love to look at this terminal chart for our radio audience. Stick with me. But basically what it shows you is going all the way back to the 90s. The VIX has really been in a range anyway from 10 all the way to 90. But in the last 2 years or so, it's kind of stuck between 16 and 38. That is a problem when you're talking about whether or not the VIX is a reliable gauge for such a volatile year. Because on the surface, it has indeed been a volatile year, but by this gauge, is it broken?
Yeah, it looks broken to me. If there was a message to come from the VIX this year, I haven't really seen it. Does not sort of match up with the intraday back and forth that we've been seeing. So that's one of the big questions next year is, does the VIX start to work again, start to reflect the reality that we're seeing on the ground? The other big question, of course, is a potential recession, is the consumer. And actually, Jonathan Golub, he is Credit Suisse U.S. equity strategist and head of quantitative research. He was on Bloomberg Surveillance earlier today talking about that.
The consumer, just think about what's going on. Their wages are staying higher, and the inflation on the things they're buying is falling, and there's an abundance of jobs. Right. Consumer confidence, and we've seen this now since June and July, the consumer confidence data is ripping, and people aren't appreciating that the consumer is going to spend a lot more money. It's going to keep us out of recession.
So his view is that consumers are going to be what keeps the U.S. out of a recession. But Paul, I mean, the question that I ask, is that resilience going to be what causes a recession? Again, when you think about what the Federal Reserve has to accomplish in terms of cooling demand.
Yeah, exactly. A recession, no recession. It's pretty split on Wall Street. But on a Thursday, guys, before Christmas, shouldn't people be home trimming the Christmas tree? But instead, they're trading stocks and are actually selling stocks today. I'm looking at the WEI function on the Bloomberg terminal. It says the volume of trading is pretty much in line with the last 30 days. So some pretty active trading. It's even 10% higher on the NASDAQ.
listen, we knew that this would be a very hard December to take a break. There's a lot of people who are working straight through the holiday season into January. It's interesting, Kriti, it's not just the VIX that's unreliable. I'm wondering if the move is also unreliable because that cross-asset volatility has just kept up all year. You're talking stocks, bonds, currencies. That will make Wall Street some money next year, by the way, if we start the year off with that kind of volatility. But it will also mean that certain trends we saw this year about the stifling of underwriting will also continue into early next year, which really puts more jobs on Wall Street also under pressure.
Yeah, well, at its core, it's the story of the Federal Reserve, right? The idea here that if the MOVE index, which really monitors that bond volatility, if it is indeed tied to the hip of the Federal Reserve, and basically this kind of game theory version of what the Fed or will not do is kind of moving the markets, then it kind of makes sense that the MOVE index might have a more extreme reaction than the VIX itself. It's something certainly we're going to dive into with derivative strategists in the coming days and weeks ahead. But to me, I got to say, the turnaround story is really crucial. People were expected to hop back into the market after the midterm election. What are they waiting for?
They're probably waiting to see what happens with the economy, no? And whether the Fed, what the end destination is in terms of what you think about where the terminal rate is. It seems like this entire year has been a Fed trade, really. For a long time, it was an oil trade when you think about the inflation story, but it just feels like such a Fed-driven market. Whether that shakes next year, I'm excited to see. But that's next year.
That's next year. Well, speaking of next year, a lot of fund managers, fixed income strategists are telling me to look at the bond market for 2023. Of course, historic losses in 2022, pretty much across the board for fixed income. But a lot of folks are saying that's the place to be potentially in 2023. And longer duration is also something that I'm hearing from a lot of strategists.
You know, it's interesting also. Duration is an interesting question. A lot of strategists, a lot of fear about duration still. I've got to say, we're talking about all of the Fed moves on the overlay of a $1.7 trillion spending bill. The consumer strong money is going into the economy. Is that going to be inflationary into the next year? And does that all scream hawkish?
Well, the question is it even priced in? Is anyone even taking into account that extra liquidity? Because you are 100% right, Shonali. It does seem inflationary. It's something that the Biden administration has gotten a lot of flack for. Even this idea of student loan forgiveness was thought of as inflationary. So why is Wall Street not pricing it in? Katie, it's wild.
It is wild. And in terms of what's priced in, what's not, it seems like stocks and bonds, at least if you're thinking about the Treasury market, seem to be singing the same tune. Something seems scary next year. You aren't seeing that in the credit market, something I've been keeping an eye on. But guys, we got to leave it there for now. We're going to be back together at 4 p.m. live on television, radio, YouTube, and on Bloomberg Quick Take. That's just under an hour. We're going to be joining together for our Beyond the Bell coverage, where we'll take you through today's market close.
You know, you talk to some of these shareholders and the sell-side analysts that have been recommending this company, recommending this technology, recommending this management team.
Yeah.
Boy, they're understandably upset.
Well, let's talk to a shareholder now, someone who has been following Tesla for a while. His name is Gary Black. He is a portfolio manager. He manages the Future Fund Active Exchange Traded Fund. That's my world. I cover ETFs. The ticker there is FFND. Gary joins us on the phone from Chicago. And Gary, I'm looking at your holdings right now. I see Tesla is your biggest position by market value, but I don't know, looking over your notes, you don't seem too pleased with Elon Musk right now.
Well, it's definitely hurt us this year. And I guess, you know, look, we look at Tesla and it's got great fundamentals as EV adoption, global EV adoption. Right now it's about 10% global. We think it'll be 60% by 2030. Tesla earnings should explode. And, you know, from a fundamental standpoint, we're looking for about $7 in earnings next year, which kind of puts Tesla at about an 18 PE, which is about where the S&P is, but it's growing earnings at 40 to 50% a year. But it's the noise from Twitter and Elon tweeting out his political views and all the drama that is killing the stock right now, and we just have to stomach it and wait till that ends.
Well, it's interesting, Gary. I mean, Tesla is theoretically a publicly traded company. It is public shareholders. board of directors. As a shareholder, are you frustrated that no one entity, no one person, whether no board is able to rein in Mr. Musk?
I believe that the reason you saw this Twitter poll that came out Sunday night where he said, should I step down from Twitter as CEO? I think the board pressured him to do it. I've been on 2 public boards. I've been a CEO. I know very few public boards that allow somebody to moonlight as a CEO at another company. I certainly wasn't able to do it. And, with Twitter, he's basically rebuilding it from the ground up. So I've, written letters to the board. I've, not been an activist because we don't practice that style of management. But I'm frustrated. I know Leo Kogoin, who's the 3rd largest individual shareholder after Elon, and Larry Ellison has voiced his frustrations. Many of us are frustrated, but I believe that the board is trying to pressure Elon in a nice way, in a constructive way, I'll say, to do the right thing, which is to step off the Twitter board, bring in a new CEO, and focus on Tesla. Tesla has a clear path to being a $3 trillion company because of FSD, because of EV adoption, because of all the new product launches coming, like Cybertruck. There's a $30,000 EV coming. And yet, it's from a stock standpoint, it's failing miserably because of all the Twitter noise. So I do believe they're trying to do something about it. I don't think that poll would have just showed up out of nowhere on Sunday night unless the board was pressuring him to step down.
Gary, did you vote in the poll?
Of course, I voted yes. And look, one of the debates is, did Elon know the results beforehand? I think he viewed that he was going to win, meaning the people say, no, don't step down, because he was tweeting all throughout the poll, like, be careful what you wish for, and nobody can do this, nobody would be foolish enough to take this job. And, that's partially true because he has vowed to stay on as the head of, I think, software and I don't know what he calls it, but servers. And look, if we can go through the names of people who I think could be interested, but if I'm one of those people, I don't know if I would want to sign up if he's going to be very, very involved. And look, what he's done, again, I'm voicing my frustration. I'm not knocking the guy because he's brilliant. But, he has basically blamed the Tesla stock price decline on the Fed raising interest rates.
Yeah.
And that's just not true. If you look at Tesla's stock price this year, through September 30th, they were actually outperforming NASDAQ. They were down 25, but NASDAQ was down 33. Since October 1st, Tesla is down 52, and NASDAQ is down 3. And, what has happened in that time is they missed on third quarter volumes because of China, and that's, again, their own fault because they didn't have a $30,000 EV, 1. And then 2, he took possession of Twitter and then, made a series, I'd say, of mistakes at running Twitter. And, he angered a lot of the advertisers by saying, if you leave, I'm going to name and shame you. That's not the way you treat an advertiser. And then there was a constant action that, created a lot of drama. Like when they launched that Twitter Blue and, they didn't think it through and people signed up, and then you had things like, Super Mario putting his middle finger up, and if you're an advertiser, that's what you're most concerned about, product adjacency. So I just think the drama's got to stop. And then, the third thing is him tweeting out constantly his political beliefs. That's fine. He can have his political beliefs, but you're gonna anger the when you accuse people of having woke mind virus and stuff, words like that. You're basically angering the very people that you're trying to get to buy EVs. And so the big question that we have, and everybody's trying to figure out, and this is why I think the stock is getting hammered, is the Tesla EV brand taking a hit because of all this Twitter drama? And I would say I don't believe so, but the more he stays on Twitter and keeps tweeting out, stuff, I think the more likely it is that the EV brand takes a hit, and it becomes no longer cool to drive Teslas anymore. It becomes almost like I don't know. It's people will be embarrassed if he doesn't knock it off.
So, Gary, given that backdrop, who in their right mind would take the job as CEO? Do you have any thoughts as to, I don't know, who might take that job? Because they're not even really going to be the CEO.
Yeah, well, look, the people who are qualified, if Elon would let them do the job, Sheryl Sandberg, ex-Facebook, could clearly do it. Brett Taylor, he's ex-CRM, Salesforce.com. He was the co-CEO. He could do it. Marissa Mayer, ex-Google, and Yahoo could do it. But, you need somebody who really can regain the trust of advertisers. You need somebody who's proven they can monetize a user base, because Elon has said he wants more user fees and he wants to do more e-commerce. You need somebody with, a tech passion, because Elon is not going to hire somebody unless they're technologically, they have good tech skills. You need somebody with strong financial acumen, because the company's got huge debt. And then you need somebody who can lead the troops. And then I would add a sixth factor. You need somebody who complements Elon, that Elon respects and shares his vision and his work ethic. And look, there's probably a handful of people in the world that can do all those six things, but it can't be somebody who's just there are a lot of names being thrown around, that is just a tech person, who has a YouTube podcast and talks about technology, which some of the names out there have said that. That's crazy. People won't respect that. So I think there are people out there, but will Elon give the person enough room to actually make decisions and, do what they need to do if he's going to still be involved? I think that's the challenge. And look, during the interview process, that's what you figure out. And I've worked for, entrepreneurs before as CEO. And that's something you have to figure out. Will the person give you room to make decisions or not?
And Gary, just a little bit more of a technical Wall Street question. Do you have any knowledge of some of these stock sales from Elon Musk? Were they solely, primarily to raise cash to support the debt, or were they potentially margin calls from investment banks where he may have pledged his stock as collateral?
No, they weren't margin calls. I know that because he doesn't margin himself up that much. And look, there was $7.5 billion worth of Tesla's. Elon sold $7.5 billion worth of stock since he took over Twitter. So since October 27, he sold 41 million shares. And what I gather from both talking to people and listening to him on podcasts, that is going into Twitter. It's partly to refinance some of the debt, which is very expensive. There's about $3 billion of debt that is 11.75%. And plus, I think, he's mentioned this, it's burning cash at the rate of about $3 billion, while he's cut about half the people out. Actually, more than that.
Gary, we only have about a minute left with you, and I want to get back to Tesla. And at a certain point, do you start selling out of Tesla? Again, it's the biggest position in your fund. At what point would that change?
If we thought fundamentals had changed, meaning that the brand is now no longer in favor and people aren't going to buy it anymore, we would cut our estimates and we would sell some. But at $124, the stock is selling at the same multiple as the S&P 500 for next year on our estimates, and yet it's growing at 40% a year. And I can't, in good conscience, sell it now.
Are you adding?
We've been holding off because we felt that there still could be some more. You got window dressing going on. This is more from a trading standpoint. People who've lost money. Tesla's down 64% this year. Do not. And this is more hedge funds. They do not want to show it in one of their top 10 positions. Institutional managers aren't so focused on it, but that's something that we've kind of been waiting for. And look, we'll probably get to it at the end of the year.
All right, Gary, unfortunately, we have to go. We have to catch up with you next year. That is Gary Black, portfolio manager of the Future Fund Active ETF, joining us on the phone from Chicago.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
And this update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to apply for a payroll tax refund for your small or medium-sized business if it was impacted by COVID-19. Innovation Refunds clients already claiming over $2 billion in payroll tax refunds. You can get started by going to getrefunds.com. We're less than 45 minutes until the closing bell. Let's get you updated on what has been a down day for the equity market through the day. Bill Maloney is at the Bloomberg Macro Squawk Desk. Hi, Bill.
Hey, good afternoon, Doug. U.S. stocks off their lows but remain under pressure, helped by higher-than-expected economic data and bearish comments from David Tepper. Dow's currently down 393 points, was down 804 points. S&P's dropped 63, and NASDAQ is down by 2.4%. The U.S. 10-year yield at 3.67%. Gold is down 25. Oil is in the red, and Bitcoin is lower by 0.9%. Among the main 11 S&P sectors, all were trading in the red, led by declines in tech and consumer discretionary. Leaders to the upside in the Dow, Verizon, and Nike, while Boeing fell 4% and led to the downside. After earnings, Micron fell 3.5%. And in other news, Sam Bankman-Fried to be released on a $250 million bond, and YouTube to pay roughly $2 billion a year for the NFL Sunday ticket. Wrapping things up, Tesla fell as much as 11% to its lowest level since 2020. Live from the First and Breaking News Desk, I'm Bill Maloney. Doug?
Thanks, Bill. And to get live audio updates right on the Bloomberg terminal, the function is SQUA Go. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. We appreciate it. Well, how about this lead? I love this. The data are so important, staff were once instructed to have no facial expressions when walking the reports into the West Wing of the White House. And yet, a surge in trading last week in the minutes before the release of the Consumer Price Index, a closely watched U.S. inflation measure, spurred concerns the figures may have fallen into the wrong hands. The reporter on this story is Reed Pickard. She joins us somewhere warmer. I think she's on the phone from Florida. So, Katie, that's how you do it. You go to Florida before the storm comes.
You know, I couldn't get clearance to anchor radio from the phone.
Oh, okay. Yeah. All right, that happens. But Reed Pickard, she got it clearance. So, Reed, this is a great story here. And I know this CPI data is so important for the markets. Markets are laser focused on anything on the inflation front. Any sense of what happened last week?
You know, unfortunately, we don't have a lot of details on what happened, and kind of that was the impetus for this story, is kind of slowly trying to figure out all of the kind of potential things that could have happened, any details that we have around it. And so last week, the Bureau of Labor Statistics told us that there was no evidence of their systems being compromised in any way, so no hack. And then I thought it would be a good time to take a look at who sees this report and who touches this report in the week leading up to it. And it turns out quite a few people, though those few people are, very tightly watched and to have a lot of protocols on them in terms of making sure that that data doesn't get out early.
Tell us who they are. Who are these people? Who gets to see CPI before 8:30 a.m.?
So it starts with the folks at the BLS, and about a week before they start, preparing this report, reviewing this report. So kind of several people who are either producing the report or, reviewing it for accuracy, that type of thing. And then from there, on the day before the report is when it kind of starts moving out of that BLS circle, and it moves to the Council of Economic Advisors. And the Council of Economic Advisors spreads it even further, where they give it, offer this data to the head of the National Economic Council, Brian Deese, to the president, as well as a couple folks at the Treasury, like Janet Yellen, and at the Fed, like Jerome Powell. And then you get to the day of the report, and some folks at the Labor Secretary's office will see this report as well. So it's all people who are very closely tied to the economy, to economic policy. But it is really interesting, it was really interesting doing the reporting of this story to kind of see how it moves in different places to these folks that it's still very much a strictly need-to-know basis. but it, does move beyond the walls of BLS.
Interesting.
Quite
And so
substantially.
I could never be a part of that group because I have a terrible poker face, and the reporters would see it immediately as I walked it into the White House. But so, Reed, has there ever been problems with keeping this data under wraps before? Have we ever had an issue here?
Not that I know of. So I know that there were kind of rumors of it a while back, but I mean years and years ago. And then after some investigation, it turned out to not be the case. So that's what really makes this such an enigma in terms of when you ask the government if there's anything that went differently about this release than there had been the release in the month before, which was as equally watched. They said there was nothing different. But the trades in of itself in that minute or so before the CPI are just so unusual that they've really captured the attention of a lot of folks in markets, and have really kind of played into these concerns that somebody somehow figured out what that number was and made a good bit of money off of it.
So are they investigating that? Because again, I mean, I've been covering markets minute to minute, second to second moves for a few years now, and I haven't seen something like that. I mean, I've only been doing it since 2016, but still, that was a long time ago. Is anyone investigating what happens? Where does this go from here?
So we reached out to both the SEC and the CFTC because both of those regulators would have the authority to kind of investigate any potential attempts to manipulate the Treasuries market. And the SEC declined to comment on the existence or non-existence of a possible investigation, and the CFTC declined to comment. So we don't really have any knowledge in terms of whether they are pursuing an investigation or this is being really looked into. We do know that the BLS really looked into it on their side a bit, and whenever I asked them about it, they had said they didn't see any suspicious activity in terms of how their systems were. But it's definitely something that we as Bloomberg are going to continue to look into in the weeks ahead.
Hey, Reed, you cover the U.S. economy for Bloomberg News. We had a pretty big economic print today. GDP came out 3.2% on an annualized basis, or I guess quarter to quarter, on an annualized basis. Better than the consensus at 2.9%, better than last month, which was 2.9%. What did you take away from the GDP print today?
Yeah, so, honestly, it's very surprising to see that substantial of a difference in terms of the third estimate of this number. But what you saw an upward, a really pretty solid upward revision to consumer spending that reflected some new data on the services side that showed stronger than previously reported spending on services. And what it really showed us is that, while the economy really had slowed in the first half of the year, there was a lot of monthly data that had shown things were really picking up in the second half of the year, and GDP, was really reflecting that. And, one thing that I tend to look at is the average of GDP and a measure known as the gross domestic income, or GDI. And that average, is up to 2% in the third quarter, which really pushes us out of that kind of stall speed mentality and numbers. So it'll be really interesting to see what momentum looks like in the fourth quarter, and if that kind of positive momentum can continue into next year, since so many folks are expecting a recession next year.
And so many folks are expecting a recession next year. The Fed, they're never going to forecast a recession, but if you really parse the dot plots and read the tea leaves, it feels like they got a little bit closer. Am I making too much out of, what exactly their SEP said?
Yeah, the SEP was, to me, was kind of outright depressing. I mean, whenever you see an upward revision to unemployment, that's not ideal. And I know Powell, talked about how the natural rate of unemployment is likely higher, but more generally, historically, the unemployment rate, whenever it moves up a full percentage point, it doesn't tend to stop there. It tends to keep going up. So, when I looked at their SEP, that was what really jumped out to me, along with the upward revisions to the inflation forecast. But yeah, I mean, from the perspective of the Fed, it was certainly a much more downbeat look on kind of where they see joblessness next year and where they see economic growth as well. I mean, they changed their real GDP from 1.2 to 0.5 next year, which, yeah, that's not in contraction, but I mean, it's barely rising.
Yeah, absolutely. Interesting to see how they're going to play this over the next couple of Fed meetings. Reed, thanks so much for joining us. We appreciated checking out that story today on the CPI data. We'll keep on top of that. I know you will and your team. Reed Pickert, U.S. economy reporter, Bloomberg News, on the phone from Florida.
Oh, that one hurts.
Yeah, some people got out of Dodge before the storm came in. But it's going to be a crazy 24 hours here in New York. 48 hours as this, temperature drops 40 or 50 degrees, and we go from, like tropic rain and thunderstorms to 10 degrees.
I haven't even checked the weather in New York over the weekend because I'm just so confident that I'm going to get out. We'll see what happens.
Yeah, my son's in Denver, Colorado. It's 25 below there.
Yeah, no kidding.
Last night,
25 below?
Yeah, and so I don't know. It's crazy weather, and it's coming across the entire country, over the upper Midwest now, and coming our way. Kind of now.
Kind of now. If we could get some snow, that would be nice. Yeah, I don't think
that's happening. No. All right, right now let's head down to, actually, we do it here in New York. We do world national news with Wendy Gillette. She's in the Bloomberg 1130 newsroom just downstairs.
Yeah, that's right. Thanks so much. A witness described to the House committee investigating the January 6th attack on the U.S. Capitol a pressure campaign from allies to former President Donald Trump to influence her testimony and cooperation. The new disclosures about closed-door testimony from former White House aide Cassidy Hutchinson were just made public. Hutchinson's testimony included Trump's alleged outburst at his security detail, including trying to take the wheel of his SUV when they refused to take him to the Capitol on January 6th. The Senate gives the green light to a $1.7 trillion spending package that funds the federal government through September. Bloomberg's Amy Morris on the delays that led up to the bill's passage.
Leaders had planned to pass the measure last night, but got bogged down in a fight over amendment votes, especially one over immigration restrictions. Republican Senator Mike Lee's amendment to bar officials from ending Title 42 pandemic immigration restrictions was a key sticking point as negotiations on a time agreement fell apart. Lawmakers included more than 7,000 earmarks totaling more than $15 billion, with projects included for police equipment, highway infrastructure projects, and museums. In Washington, I'm Amy Morris, Bloomberg Radio.
There is still more work to be done before lawmakers can go home as that big storm is hitting much of the country. The House still has to pass the bill before it can go to President Biden's desk. House Speaker Nancy Pelosi gave her final news conference in the leadership role. She talked about how far Democrats have come in terms of diversity.
I take great pride that our caucus is about 70% women, people of color, LGBTQ. The beautiful diversity of America.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So as we make our way to the closing bell, which is in about 20 minutes from now, the equity market is in retreat. The good news is that we are off session lows right now, but the tone has been negative through the day. A lot of worry about the quality of corporate earnings, the debate continuing about an earnings recession. Maybe we're already there. And then the negative impact of further Fed tightening, which seems very likely, particularly when you look at today's economic news. Initial jobless claims rose less than forecast last week, and the final reading on third quarter GDP was revised higher. We've got the Dow Industrial Average down about 1.3% at the moment, the S&P weaker by nearly 1.8%, and the NASDAQ comp down more than 2.5%. Tech shares are very weak today, particularly the semis. It was after the bell last night. Micron Technology gave a revenue forecast that was weaker than expected. The company went on to say it's going to reduce headcount in the new year by about 10%. So a lot of weakness in chip-related stocks, particularly the semiconductor equipment makers. One reason that we're seeing the Philadelphia Semiconductor Index down in a big way today. Then there's the story on CarMax. We were just talking about that a moment ago. CarMax with numbers that disappointed, coming in below already reduced expectations, and right now CarMax shares weaker by about 4.5%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. We appreciate that. As always, Bloomberg Business Week is brought to you by Innovation Refunds. Your business may be eligible to receive a payroll tax refund. The application takes around 8 minutes, 8 minutes or less, to see if your small to medium-sized business may be eligible for a refund of up to $26,000 per employee kept on the payroll during the pandemic. Find out at getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, we are about 18 minutes away from the close of trading on this Thursday. Let's get a little insight on the action with Christopher Zook. He is founder, chairman, and chief investment officer over at CAZ Investments. He joins us on Zoom from Houston. Christopher, great to have you. It's looking like an ugly end to an ugly year. Thinking about 2023, do you see any brighter lights there, or is there more pain ahead?
Well, thank you for having me. It's tough to be in a bad mood when you hear songs like that in the intro, but then you look at the screen and everything is red. So it just kind of wakes everybody up and makes them a little bit of a reality of what this year has been. So, we do look at 2023 much the same as we did when we started this year. We talked about at the beginning of the year what we call the double punch to the gut. When you look at most major bear markets, they comprise of two phases. The first phase is the valuation compression as everybody goes, oh, it was way too high, it needs to be lower. And that first punch hurts. But it's the second punch to the gut that really, really does the damage, because that is the earnings recession. That is the earnings decline. And we feel like we're at the beginning of that. And whether you talk about CarMax or you talk about some of the other names that have not been great, Micron's numbers, et cetera, it is clear that we are at the beginning of this earnings decline, not the end of it.
Chris, I love your resume because it's got some of the names that I just love on Wall Street. Prudential Securities, Lehman Brothers, and one of my alma maters, Payne Weber. Great firms. Unfortunately, none of those three are around anymore. So I'm not sure what that says about you and me, and maybe been too long in this business. But, Chris, you could take a look at the argument that says, all right, I've got peak inflation. I've got light at the end of the tunnel as it relates to interest rate increases. That's probably a mid-23 event. And how much can earnings risk be? So I got 2 out of 3 things working for me. Maybe I should be putting on some risk here as I go into 2023. But you think that earnings risk component is still too much you don't want to get in front of that?
No, I think so. You definitely have to look at the third as the most severe.
Okay.
But I'll add a couple to them, all right? And to be very, very clear, this market right now, rallied again for no real reason. it is likely to come down, and obviously today is maybe the precursor of things to come. But what concerns us the most right now is the consumer, because most people are not talking about that. They're talking about the Fed, they're talking about rates. All those matter tremendously. But the actual economy and what drives companies' earnings, 80% plus of the GDP, last time we looked, is the consumer themselves. So those consumers are just now beginning to feel the real impact of rates that have come through this year. You know, look at, I think the number was a $2,500 mortgage payment, you know, at the beginning of the year would buy you a $480,000 house. Today, it's something like a $320,000 house, or maybe even less than that. That is a huge wealth effect and a negative wealth effect. CarMax is just a great example, where everybody and their brother bought a new car or a used car, a new to them car, in 2020, 2021 with all the stimulus money, and now they're like, maybe I don't need a new car that much or a new used car that much, so I'm going to delay those purchases. And as we see that decline of demand and combine that with a rising costs that are still there, inflation may be peaking, but margins are still going to compress because expenses are high and demand is dropping. Profit margins compressing is usually what causes most major earnings recessions to occur.
I want to talk about the bond market a little bit. You know, we've been talking a lot about the equity market, which hasn't been too pretty in the bond market either. But Christopher, I look across Wall Street, it seems like everyone is a bond bull. Do you fall in that camp as well?
No, we don't. And it's because we tend to be a little bit contrarian. We definitely got more bullish when things in September, October probably went a little bit too far, because the Fed is going to begin to taper and they're going to slow their rate of increase. But the market right now is forecasting by the end of 2023 that the Fed is going to cut rates as much as 140 basis points. We think that probably is a little optimistic. It's likely that that's pushed out into 24, et cetera. So if inflation stays stubbornly high and the Fed does not give an indication that we're going to be cutting rates anytime soon, we feel like that could be a real bad place for investors to be. The only exception to that, and I'm going to disagree with myself here for a second because I think it's important. The only exception to that would be if the recession turns out to be a doozy, technical term. If it really turns out to be bad, well, then the long end of the curve is going to come down a lot more, in which case it would make sense to be bullish long-term 30-year bonds, maybe even 10 years. But realistically, we don't expect it to be a GFC-type recession. We expect it to be a serious recession, but not that bad. And so we think that the bond market has already adjusted a lot to what's likely to occur. So from here, the risk-reward is just not very good.
So no haven bid necessarily.
I don't think so. You could see it if the recession turns out to be just a draconian type scenario. You could see that haven bid, but we feel like that's going to be more on the short end. You're just going to see more money flow into, 2s and 5s and that kind of thing, as opposed to going out and taking more risk on the 10s. Again, if it turns out to be a GFC type and 10 years going to go back to 150, well, then, yeah, you want to be long 10 years right now. We just don't think that's likely to happen.
Chris, we know you're in Houston. We know you're a native Houstonian. You're involved in the community. Just give us a sense of on the ground. How are things in Houston? How's the economy? How's the outlook as we come out of this pandemic?
We're doing really well as a city, and it's a combination of how the energy markets are certainly a lot more favorable than they've been in a while. We also have such a dominant healthcare, and fantastic healthcare facilities, here with the Texas Medical Center, and so much else that we've done to diversify our city. We're dealing with some of the other issues related to commercial real estate that everywhere else is right now, but not as bad. So when we look at the major pockets of the city, we're actually doing really well. We've got good job growth. We've got a lot of people moving here from other parts of the country. And so when you have good job growth and you have new, people moving in, it means that our housing markets are, pretty stable and doing okay. And then we also have a healthy job market for people that want to come here to work. So we welcome you to Texas.
Good stuff. All right, Christopher, we really appreciate you taking the time. Christopher Zook, founder, chairman, and chief investment officer of CAZ Investments, joining us via Zoom from Houston. He has a cautious outlook, pragmatic outlook, a cautious outlook, and he says you probably don't want to get in front of earnings revisions, downward earning revisions, and he thinks we still have more to go for earnings next year and beyond. We'll have more coming up. This is Bloomberg.
It is now 3:53 on Wall Street. I'm Doug Krisner at Bloomberg World Headquarters with a look at some of today's company headlines. An energy storage company backed by Bill Gates' Breakthrough Energy Ventures is now planning a factory in West Virginia. Construction there to begin in 2023 at a cost of $760 million. Manufacturing is set to begin in 2024. The parent company of TikTok, China's ByteDance, has found that some TikTok employees inappropriately gained access to data for some U.S. users. This is sure to complicate already fraught efforts by TikTok to convince U.S. lawmakers that its app is secure. A Senate committee is looking into whether automakers are using parts and materials made with forced labor from China's Xinjiang region. Dow Jones saying 8 car manufacturers have been asked to provide detailed information on their supply chains. The U.S. bans most imports from Xinjiang under the Uyghur Forced Labor Prevention Act. The earnings from CarMax came in well below already reduced expectations. These results are deepening concerns about a very weak U.S. used car market. AMC wants to convert preferred equity units into common shares, and the company is proposing a reverse 10-to-1 stock split. And Scott Minerd has died. He was the CIO of Guggenheim Partners. Scott Minerd died yesterday. He was 63. Those are some of the company stories we're following this hour. I'm Doug Krisner in the Bloomberg Newsroom. We'll have much more as we approach the market close at the top of the hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Scott Minerd, the Guggenheim Partners Chief Investment Officer, who was regarded as one of the bond kings of the past decades, has died at the age of 63. Minerd died today at his home in Rancho Santa Fe, California, after suffering a heart attack during his regular workout. Guggenheim confirmed his death in a statement. Well, earlier this year, Bloomberg Quick Case Scarlett Fu talked to Minerd about the biggest mistake he made in his career. Here is a portion of that conversation.
I was working for Price Waterhouse. It was 1980, and real estate prices had been skyrocketing in Florida. And so I wanted to get in on the real estate boom. I managed to scrape together everything I had, and I found this condominium that I could just get into. I bought it.
How much were the interest rates?
At that time, I got a special subsidized mortgage, which was 9 7/8%.
Ooh.
Right.
When did you realize that it was a mistake?
Well, you mean a fully a mistake?
Yeah.
Because it was about a week after closing, I started to have second thoughts. I began to realize, as prices began to soften and decline and sales were going in,
What was the listing price?
it was I think it was $54,750. You remember this when you suffered through something.
That's very exact. And you said your monthly payment on the mortgage
It
was?
was about $600.
And your annual salary at the time was only?
$15,000.
Okay.
That was the mortgage and taxes. I started to feel like a captive. It wasn't like, if I decided I wanted to change jobs or move somewhere, I was tied down with this property.
Did you make a phone call to anyone about this? I mean, did you tell anyone about this experience, or were you?
No, I was hiding.
You were hiding?
Well, I was embarrassed. My family saw me do this. Everybody saw me do this, and I'd actually gone to my grandparents to get some of the down payment.
Is this something you think you could have learned from a textbook or from someone telling you, or did you have to experience it firsthand yourself?
It taught me a lot about the usefulness of history, because Florida, South Florida in particular, is notorious for real estate booms and busts going back to the 20s. And so, it probably affected the way I looked at all investments going forward, which was not to just listen to the conventional wisdom of what everybody else was saying, but to take what they were saying and, actually, really in reality challenge it.
That was Guggenheim Partners Chief Investment Officer Scott Minerd, who passed away earlier today at the age of 63. And we're going to have more coming up. This is Bloomberg. Good afternoon.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Kriti Gupta, Shonali Basak at the anchor desk, counting you down to the closing bell, and here to take us beyond the bell with the global simulcast. We're joined now by our colleagues Katie Greifeld and Paul Sweeney, bringing together our Bloomberg television, radio, and our YouTube audiences. You can get us anywhere around the world to, of course, parse through the crucial moments of the trading day. Katie, it has been a wild day in the markets. We talked about this earlier in the show. How many people have just decided to throw their hands up in the air, go home, drink some hot chocolate, and watch this sell-off continue?
I'm not sure that's what they're drinking.
But I don't know. If you look at the volume, it's not as low as you would expect today. It's pretty much average. And you look at the S&P 500 right now. It's still down 1.5% to be sure, but we were looking at losses of 3% earlier, so it's halved those.
Yeah, that's kind of what I'm looking at here a little bit. The trading kind of in that last half hour, we kind of came off the lows a little bit here, so that gives you a little bit of optimism. But we've just talked to a guest earlier today who put out a very, very credible bear case, which is basically we got more earnings risk in this market, folks, and that hasn't really been factored in.
Yeah, there's earnings risk in the market. There's still rate risk in this market. There's all sorts of risk in this market at the end of the day. And, even if you believe inflation is peaked here, it's not just the fact that it's rolling over that you're watching. It's the pace at which it comes down. I think that's the important story that is being lost here every time someone comes on and says that inflation has peaked. Inflation has peaked.
And I think the liquidity story continues to be a really big story as we talk about simply how much people actually are able to make those market bids and market spreads that you are seeing in the market right now at a time, by the way, when Shonali's been talking about this whole time, $1.7 trillion is about to be pumped into this economy.
Well, those are the closing bells. You can see the S&P 500 off by 1.4%. The NASDAQ even worse, down by 2%. Look at the Dow, though, the relative outperformer there, Crudy.
Yeah, it really is. And to me, I think it's the momentum trade that's really important. The NASDAQ, the Russell, are you starting to see those starting to sink back up at a time when those chip stocks are really dragging down the S&P 500? And I would argue the Dow as well.
And you look at the S&P 500, 88 names closing in the green. That means over 400 were closing in the red. So pretty broad-based selling there, Shonali.
Yeah, broad-based selling. Let's just take a look at just how much red there has been today and how deep that red went, because autos, semis, autos down more than 7%, almost 8% on the day. Why is that so interesting? You have everything from worries around used cars with CarMax and Carvana to Tesla and the discounts it's providing here, being watched very closely. Semis, remember Micron had a very disappointing event yesterday when it came to earnings releases, as well as outlooks, as well as job cuts. So you are seeing a lot of pain here. Even energy down 2.3% on the day. That is the favorite of the year. It is selling off just a little bit today. You had a little bit of green on the screen. Telecom, consumer durables up basically 0.5%, but not a lot of love in the market today, guys.
Not a lot of love. I did find 3 names at least in the green. Let's start with FedEx. Of course, they reported earnings earlier this week. We're talking about price hikes. We're talking about cost cutting. Management increases the estimate of savings to about $1 billion. Shareholders seem to love it. You're looking at a second day of gains. That stock up over 3%. And that makes sense. That's an earnings story. I have 2 mysteries coming up for you, though. You have VF Corp. So FedEx was the biggest gainer in the S&P 500. This is the second biggest gainer. It's up for a second day. I don't have a good reason why necessarily, but it is up about 3% in a down market. And then moving on, we also have Warner Brothers Discovery, also up for a second day, also with no clear catalyst. Maybe people are watching a lot of holiday movies, but in any case, that stock higher by about 2%, Paul.
Yeah, plenty of losers to look at here on this Thursday trade. And let's start with Tesla, down 9%. And, you know, as Matt Levine in his Money Stuff column will say, oh, Elon. So there's still that Elon pressure as it relates to what's he doing with Twitter. But there's also some fundamentals out there. For the first time for Tesla in a long time, they're actually offering an incentive on some of their cars. And that goes to the question of demand out there. How is the demand for electric vehicles and for Teslas in particular, given that the economy may be slowing, inflation, and consumers may not have that discretionary spending for a new car. Carnival Cruise Lines, I am not a cruiser, but I do know many cruisers, and they are adamant that they are going to continue cruising. Carnival Cruise Line yesterday had some results that were generally in line, but the guidance was weaker for the 2023 than I think some people were looking for. So, again, still some issues there. And then as you guys were talking about earlier, NVIDIA, one of the leading chip stocks, down 7%. And that's kind of on the back of, you know, the Micron news, which is kind of really put some pressure on the chips across the board, and NVIDIA certainly getting caught up in that.
Yeah, Paul, and part of that inflationary story in the past year or so has been the chip story, because we couldn't catch up to the really a mind-blowing demand that you saw in that space. That led to the inflationary story and yields higher. Today, it's a similar story where you are seeing the front end of the curve really see a pretty big move. 6 basis points higher on the 2-year yield, 427, inching closer and closer, but not quite there to that terminal rate. At the long end, we are also seeing a move, but really only 2 to 3 basis points between the 10, 20, and 30. So really seeing a sell-off more towards the front end, Shonali.
Yeah, so many things to bake in here. Cross currents, as we keep talking about them. It's been a yield story all year. 368 you're seeing on that 10-year. But listen, there's more data to be had. This year's not over. We're looking at PCE that is expected to undershoot the Fed's forecast. That's what is expected from Bloomberg Economics. I am excited to see how this pans out. There's also, by the way, that massive spending package that we are looking, $1.7 trillion. And boy, does that set us up for next year.
It does set us up for next year, a year in which at the same time you're expecting to see the earnings outlook deteriorate. How many times have we heard the phrase earnings recession in the past couple of weeks? Doesn't seem to be priced yet in when you look at the earnings estimates expected out of Wall Street. But at the same time, what that means for the bond market, again, Shonali, like you said, I mean, the yield story has been incredible this year. And I don't know about you guys, but everyone I talk to, and that's only slightly in exaggeration, is bullish on bonds right now.
Bullish on bonds, and talking about duration, maybe going out a little bit longer on the duration curve here, and that's maybe the way to play this bond market. But like Katie was mentioning, a lot of bond bulls out there, and that's I guess not surprising after one of the worst years, if not the worst year in fixed income in 2022.
Well, baked into that bull case is, once again, I'm going to quote Ira Jersey, chief rate strategist over at Bloomberg Intelligence, is this idea that Fed cuts priced into the back half of 2023 are going to cap those yields. So that's kind of this opposite direction or opposite pressure that you're going to see from the inflationary story. And Shonali, let's push this forward here, because at the end of the day, you mentioned the PCE data. It's not the only data we get tomorrow. We also get UMich consumer confidence numbers, which ordinarily isn't something a lot of people trade off of, but in the last couple of iterations of that data, it has been a market mover.
It has been so interesting, especially as we've seen some positive consumer data come out earlier in this week, and the hawkish sign that was embedded in that data between spending, between the consumer. Remember, there's plenty of stimulus still in the system. Is there reason to stay hawkish if there's not a hard landing here, if there's only a mild recession as consensus says? The crazy thing about all of this is if consensus from, again, the sell side here is for a cut at some point next year, that means the offsides risk is a risk that a lot of people have been putting up here that they hold or even raise. So something to keep an eye out. 2023 is already tiring me out.
Exactly. Well, if you talk to some of the more bullish people out there, and I'll talk about Vince Signorello, who's a macro strategist for Bloomberg News, and his call is basically the Fed can stop. The Fed can stop right here. Inflation is coming down. It's peaked. The Fed rate increases have done their job. They're doing their job. And once we get to that point, that's when risk assets take off. He thought it might be late 2022, too early there, but perhaps in the first half of 23, the market will begin discounting what might be a better rate environment.
I love Vince, but that is a big call. I mean, there is a lot of daylight between a 7% handle and the 2% target that the Fed is still sticking to. Powell had the opportunity to back away from it at that December Fed meeting. He didn't, and I know that they're concerned about the lagged effects of their tightening, but at this point, I mean, what we have heard from the top down is that it's way too soon to stop.
Yeah, well, Vince has certainly been the contrarian, but I think at the core of the trade is the idea that there is this kind of PTSD from several decades ago. We don't want a Volcker repeat. We don't want to basically put this market and this economy on autopilot for that inflationary come down, only to have to reverse and go in the other direction.
You hit the nail on the head. The risk here is that you have to abandon 2%, and that is the big worry that would have much more structural damage. Right. And all of a sudden, you and I are not talking about quick pivots into next year. We're talking about a much bigger, longer problem here.
Well, the good news for everybody is I will be here next week bringing it all to you. So we'll have to see how this plays out. But we got one more big trading day tomorrow. Then we'll see how it goes post-Christmas.
Yeah, it really does. I mean, I've been saying this for about 2 weeks, but it really feels like we're really at the end of the trading year. When you think about, we have PCE tomorrow. We have those UMich numbers. I'm logging off at 1:30 tomorrow. So good luck to you guys, because that does it for our cross-platform coverage of the market close on Bloomberg Television, Radio, YouTube, and on Bloomberg Quick Take. You guys will be back tomorrow, same time, same place. All right, Paul. I mean, it's a good point. We do actually have some data to look at tomorrow, and we were talking about it a little bit. UMich, that is a market mover. It didn't used to be, but it feels like in this weird economic environment we've been living in, every single data release is a top-tier data release.
Because I think, obviously investors are trying to get a read on inflation, because that will help them get a read on the Federal Reserve. And in addition to whatever earnings risk may be in this market, and our prior guest really called that out as a big risk for 2023, the Fed's really been moving this market here.
Oh, yeah.
And so it's kind of really goes to, how is inflation in this economy? How quickly will it come down? I think the consensus is that we've reached peak inflation. Gasoline prices, that's my own personal inflation number. That's down to $3.
That's your misery index?
That's $3.10 per gallon.
That's not bad.
I got it actually under $3 down at the shore last weekend. So good news there. And for the Matt Millers of the world driving around in their big pickup trucks, that's got to be almost like a little bit of a tax rebate. So you've got that in the economy and things like that. But the question clearly for this marketplace is kind of where the Fed is going. So we'll see.
Yeah, and think back to the first half of the year, especially after Russia invaded Ukraine at the end of February. For months, it was really, felt like everything was in oil trade. Like the price of oil dictated what every other asset class was going to do, and it was seen as, that is the primary driver to this inflation that the Fed is trying so hard. So it seemed like that was what was driving things. But now, to your point, it really is a Fed-driven market. We've seen oil prices come down substantially, like $77 a barrel.
It's interesting, exactly. But I'm looking at Exxon, for example. That's a big name that just comes to my mind. Somebody who doesn't really trade energy. Stock's up 73% year to date.
Yeah.
And it's interesting because, obviously, as you mentioned, oil has come down from its peak, and it's just really interesting to see how that plays. All right, let's talk about another one of the great growth stories, I think, for the next decade, 20 years. If I was, I gave my kids advice. Go into cybersecurity.
Other than trust your gut?
Trust your gut. Go into cybersecurity. It's like the plastics of the 1960s. I'll explain that reference to you later. Kara Sprague, Executive Vice President and Chief Product Officer. She's into cybersecurity. The firm is F5. She joins us on Zoom from Seattle. Kara, give us an overview of kind of from your perspective at F5, how is corporate America, how are global corporations dealing with cybersecurity these days? It just seems like because of the pandemic, maybe even more so, we put even more and more data and applications into the cloud.
Absolutely, and thanks for having me on. What we have seen over the past several decades is just an increasing reliance of organizations on their digital services and applications. And so what you see today is most companies, their fundamental business processes, the way that they engage with their employees, the way they engage with their customers, those are all facilitated by some sort of digital service or application. And the landscape for cybersecurity just continues to grow more complex. And so the reality is with this increasing dependence on applications and on digital services and the increasing sophistication and breadth of threat actors, it's becoming a very dangerous world out there.
Let's talk about those threat actors in this dangerous digital world, because it seems like, there's been so many stories of the past few years, but a big story of the past few years is just how many cyber attacks there were. And it was really spread out very broadly when you think about some of the pipelines and of the other attacks that happened. Is that the future that we're heading into? Should that be something that, the average person should expect to see?
Absolutely. And I think that future is here today. Maybe it helps to think about some of these attacks in a few categories. We hear a lot about data breaches. In the last year alone, what we would say is that inadequate cybersecurity has resulted in almost 2 billion users' passwords and credentials falling into the hands of cyber criminals. Just one example I would point to, there was a very material breach at a service provider in Australia just a few months ago in which 10 million customer records, enough to open a bank account, were taken and exfiltrated through an API that was just not protected. And so that speaks to why API security has become such an important topic. Another category of cyber threats we see are these bots. And so anybody who's really, really excited, like I am, for the upcoming Taylor Swift tour, is going to know that it was very, very difficult to get tickets, largely because there's all this automation, which was pounding Ticketmaster in order to secure those tickets on their own and then be able to resell them in the gray market. And so bots is another major threat, and that affects everything from the sneakers that your kids might be trying to buy to stuffing fraudulent credentials into various places to try and figure out and break into those accounts. If you have a loyalty card or any other kind of thing that transacts financial information, oftentimes bots are a material problem there. And then the third category I'd point to, and it's one, Katie, that you brought up, is ransomware. That was the issue at Colonial Pipeline. And what we see is that if cyber criminals get access to a network, they can install malware, which allows them to take data and then encrypt that data and then hold that data for ransom, forcing organizations to pay them money in order to get the data back. And that affects a large number of organizations. We saw a lot of them even going after hospitals in the past year. And there was a recent example in LA at a school where the data from students and parents was taken. And that was particularly sad for me because what happened there was the hacker group eventually released that information on the employees and students. And for the children, at least, it's going to be many years before they realize that many elements that are core to their digital identity have been out there on the open internet for a long time.
So, Kara, maybe I'm just glass half empty on this one. I just feel like this cybersecurity is something that we as a society will never get ahead of. We will always be playing catch up. We will always be plugging holes in the dam. Is that the right way to look at it?
Well, I think it will require constant vigilance, and it requires us to consistently raise our game. But I mean, if you look at an analogy I sometimes think about is when broadly we adopted bar soap, right? That immediately wiped out a large amount of the spread of disease. And we put in place other practices around, don't mix your drinking water with your sewage water. That was another practice that wiped out a whole bunch of pestilence and helped communities stay healthier. And so if we think about cybersecurity in a similar way, there's just some standard practices that we can all start adopting that I think will make, in general, the digital world a much safer place.
Is there a sense that at the board level that companies really have an appropriate appreciation for the investment required to ensure data security on an ongoing basis?
I would say increasingly so. It's probably, I would expect that it is not uniformly understood, but increasingly it is very much a board level topic, and board members will prioritize ensuring that companies are protected from ransomware type attacks, making sure that they can recover their operations and their operational environments, even if a ransomware attack hits them, ensuring that they have the right tools in place to detect data breaches and also remediate them. And then in the case of bots, there's technology out there that can solve in many ways the bot problem. And so we all know that the technology exists, and it's a matter of investment and putting the right prioritization to ensure that organizations implement them.
And Kara, we're talking on December 22nd. 2023 is just days away. What do you see as the biggest threat or risk from your vantage point?
I think the biggest risk, because I think we're all looking at the macroeconomic clouds and see some darkening signals. And I think the risk from a corporate perspective is that they choose to prioritize other things above their cybersecurity. And this is a thing that I just think we need to recognize is only going to require increasing focus, increasing vigilance going forward. And so it's an area where I think it would be very smart for companies to continue to invest and to continue looking for solutions for what's hitting them.
All right, Kara, really appreciate you taking the time. Kara Sprague, she's Executive Vice President and Chief Product Officer for F5, which is a publicly traded company. FFIV is the ticker to put into your Bloomberg professional terminal. She's joining us on the phone from Seattle. And boy, it just seems like you think about cybersecurity. If I was a board person, a C-suite person, I'd be like, guys, I know we have to prioritize spending, but this is something we cannot cut back on.
Trust your gut. Get into cybersecurity. That is what I always say.
Those are the takeaways from today. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Well, the equity market snapped a two-day run of positivity. Today's drop was driven by worry over an earnings recession, along with a negative impact of further Fed tightening. Tech shares very hard hit. That came after disappointing a revenue forecast from Micron Technology. And the Micron news really rekindled concern about slowing demand for semiconductors. The semiconductor equipment makers were hard hit today, and we saw the SOX, the Philadelphia Semiconductor Index, down by more than 4%. Then we had the story on CarMax with earnings coming in below already reduced expectations. Those shares were down 3.5%. Now, in terms of economic news, the numbers support the position on further Fed tightening. Personal consumption expenditures, this is the PCE index, excluding food and energy, an increase at an annual rate of 4.7% in the third quarter. That is up slightly from the previous estimate. On top of that, first-time jobless claims were up, yes, but less than forecast, and the final reading on third quarter GDP was revised higher. So at the end of the day, you have an elevated yield on the 2-year, up about 6 basis points to 427. The Dow fell 1%, S&P 500 down about 1.5%. NASDAQ comp gives back about 2.2% on the day. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, thank you so much, Doug Krisner. Well, it's December 22nd. That's all I'm thinking about. We get the next employment report on January 6th when we come back after the break. Let's talk about the labor market now with Burt Bean. He is the Chief Executive Officer of Insight Global. He joins us now on Zoom from Atlanta. Burt, it's great to have you with us. And Paul and I were just talking about it. When you walk into a restaurant, when you walk into other retail shops, for so long over the past 2 years or so, 2.5 years, I would often see a sign that said, "The whole world is short-staffed right now. Please be kind." How long are those signs going to stay up? Or, are we getting to a point in this labor market where some of those businesses can start to take them down?
I hope those signs always stay up. I think it's always nice to be kind to folks in the service industry. But I get your point, and it is such a confusing market out there because it does still feel like we are really short on labor. We certainly are. There's a lot more job openings there than there are available workers. But with everybody looking into next year, in fact, even just listening to your show now, I think everybody is expecting some type of economic downturn. And so one starts to really wonder, are all those jobs going to remain open, or are they going to remain unfilled?
And, Bert, we've seen layoff announcements, most notably, it seems, out of the technology space. Can I extrapolate that out to the rest of the economy? Because I'm looking at the JOLTS numbers. It's still got 10 million openings out there. So I don't know what's going on in Silicon Valley.
Yeah, I mean, it's what we see where we sit. I mean, Insight Global is a staffing company headquartered here in Atlanta, Georgia. We're throughout the U.S. and in Canada. We're we're the second largest IT staffing company in the U.S. But we service all sectors, and we definitely see technology is being hit the hardest right now. But there's still lots of hiring going on in lots of places, like utilities, like the federal government, like financial services. But yeah, I think every CEO right now is sitting there looking at their budget for next year saying, okay, well, if there's going to be some sort of recession coming, I need to put a plan together. I need to be somewhat cautious with how I spend money. And just that alone, I think, will drive us into some sort of at least a light type of recession next year. And so that's a lot of the stuff that we've seen in some of our survey data that we've looked at. I mean, we see 3 out of 4 Americans are really, really worried about getting laid off at this point. And while it's been a great 2 years for the job seeker, while it's even spawned things like the Great Resignation, the mass layoffs that we saw in 2020 are still fresh in everyone's minds. And so people are really, really worried about that. And what that tells me is that, business leaders just are not talking enough to their people about what is our plan. If we go into a recession, what is our plan? At Insight Global, we do not believe in doing layoffs here. People are vital to our growth. I think people are vital to every company's growth. But we see that people are really the lifeblood of our company. They're how we truly generate revenue. So to do layoffs really hurt your culture, hurt your ability to grow your business. So we are really, really big on coming up with our plan and sharing that with our people constantly, weekly if we have to make sure everybody knows that they have a part to play as we fight through the next recession. And ideally in the process, you're able to calm a lot of nerves out there.
Well, Bert, I want to connect the idea of the great resignation with this possible recession that we're heading into next year. And I mean, I know so many people over the pandemic who switched things up, who switched jobs, who felt like they had the freedom to do that, the ability to do that, because there was so much demand for all sorts of workers. And when you think about the great resignation, does a recession end that vibe?
It's not good for the vibe, I would say. But it's kind of hard to know, you know. I mean, really, I think there have been some real fundamental changes out there. People have formed real habits about how they see living to work versus working to live, and people have real views on that. So I think it's a little early to tell. But yeah, I mean, what I'll say is that, you know, if you are looking to make a change right now, I think now actually is the time, if you are a job seeker, to stay put, to try to get really, really aligned with your employer about what success in your job looks like, and make sure that you are willing to figure out what are the jobs maybe adjacent to you there, what are the jobs that are closest to maybe driving revenue at your company, and make sure that you are really, really contributing in this time. Because what I'm afraid of is that while we still have lots of job openings, while that's all still there, I'm still afraid that companies are going to come up to this recession if we go into one, and I'm afraid that we're going to see layoffs. And so what I would tell all job seekers, or all candidates, all employees, is to make sure that they know where they stand right now with their employer.
Hey, Bert, how about that whole issue about how people are going to work? Back into the office full-time at home, kind of the hybrid. I mean, Katie and I are probably one of the few people here in this Bloomberg
We're one of
headquarters.
27 people in the building right now.
Exactly, and by the way, it's one of the best office buildings in the city, I can tell you that. Give us your sense of how you think this may evolve over the next year or two.
Yeah, that's a great question. I think I saw an article this week in the Journal about zombie buildings, actually in New York City, buildings that are vacant. We're hybrid. We're 3 days a week in the office, and that works really, really well for us. But the sense I get is that we're even a little ahead of the curve. A lot of companies are still mostly remote, and again, I think habits have started to form. I think if you're an employer and you wanted to get people back in the office, I don't know if you've missed your window, but I think this is a pretty important year to try to figure that out. I think a deep economic recession certainly shifts more of that leverage back to the employer.
Right. Yeah.
And if they want to drive people back in the office, that is their right to do that. But I think lots of productivity can be gained by meeting people where they are and helping them get to some sort of a hybrid work environment. It's been amazing for us. I mean, there's huge benefits of being in the office, but there are really big benefits of being able to work at home at least a few days a week. I mean, you can get really focused. You can take care of your kids if you're a parent.
You can see your cat if you don't have children, perhaps.
You can see your cat. Yep, absolutely, all that stuff.
Yeah.
So that's been helpful for us.
Yeah, I think Paul and I are on opposite sides of the issue. I know that you think everyone should be in the office all the time. I think the flexibility is great. I don't know. I'd like to run into the woods one day, but I don't know. Thinking about, it's really interesting to hear you say that, if we get a really deep recession, that sort of the leverage would shift back to the employer, at least when it comes to remote work. But also in a recession, I'm looking through your notes. I see that, in one of your surveys, you found that 73% of American workers say that the fear of a possible recession has motivated them to upskill. What exactly does upskill mean here? And is that only in certain industries?
Yeah, it's a good question. I mean, there's more opportunities to upskill in certain industries. And so it simply means what you think. I mean, it means going out and acquiring some sort of skills in whatever, kind of closely associated with whatever you're doing to make you a bit more marketable. But if you're sitting there in a job today and you're like, well, I don't really know. I don't know if I can upskill. I don't know if there's a set of skills I can go easily learn. I think you can do that just with your overall weekly performance. Truly, I think it's getting really precise about how you as an individual are productive at work. If you don't know how to do that, talk to your boss. I promise they will let you know. In figuring out how to do more of that. So again, if we're in a recession and if your boss is faced with having to lay people off, they get to you last because they know that you absolutely are determined to stay there. You're determined to be productive and you're determined to help your company grow through the next cycle.
All right, Bert, good stuff. Really appreciate it. Love getting an update on the labor market. Bert Breen, Chief Executive Officer for Insight Global. He joins us on Zoom from Atlanta. And Atlanta is one of those markets that my entire career, Katie, it's been a growth market.
Yeah.
I mean, it's just been for 30, 40 years, and I'm sure more than that, just a great growth market. You can tell it by the traffic. People got, the brutal traffic down there. But boy, what a success story. And you think about how the economy may go into recession in 23, and you wonder how regional it might be if, around the country.
Who will be spared? Well, we're going to get an update on the labor market on January 6th. The unemployment rate, I hope I'm reading this right, the expectation is for it to stay stuck at 3.7%. That is so low, Paul.
It's amazing. It's pre-pandemic low almost. And and you would think about a recession call with the context of effectively full employment. You don't see that. So a lot of people are calling for unemployment to go up. All right, right now let's get a check on the latest world and national news. And we can do that with Wendy Gillette in the Bloomberg 1130 newsroom.
Yes, the Senate has passed a $1.7 trillion spending package that averts a partial government shutdown. Democratic Senator Patrick Leahy says it's good for both sides.
Most of what's in here has been put together in a bipartisan fashion, funding things that we all say we agree with.
Republican Senator Richard Shelby agrees with its merits.
This bill, we know what it is. We know it's an omnibus. We know it's not perfect, but it's got a lot of stuff in it, a lot of good stuff.
The more than 4,100-page bill still has to be passed by the House. It includes additional aid for Ukraine and over $770 billion for domestic programs. The war over reproductive rights is headed to a new front, contraceptive access. Bloomberg's Amy Morris has the details from Washington.
The opening salvo in Texas, a case involving a parent's ability to know when their child seeks family planning services from a federally funded provider. The judge set aside a 2021 Health and Human Services Department provision intended to protect client confidentiality by preventing Title X program providers from telling minors' parents when underage people come in for reproductive counseling. The case is limited to minors, but birth control rights advocates fear this is just the beginning. In Washington, I'm Amy Morris, Bloomberg Radio.
President Biden received a briefing from FEMA and the National Weather Service ahead of the winter storm that's hitting much of the U.S. before the holiday weekend. Kathy Pelka was crossing her fingers she could leave Chicago this morning.
We were supposed to leave on Friday, and we updated it till today, but now it's pushed back to 11:45, so we're just hoping we get on the plane.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
2 days of positivity in the equity market came to an end today, given worry over an earnings recession, along with the negative impact of future Fed tightening. A lot of weakness in tech stocks today. That followed a disappointing revenue forecast from Micron Technology. This news from Micron served to rekindle a lot of worry about further weakness in demand for semiconductors. The equipment makers, semiconductor equipment makers, among the big decliners today, and that helped to send the Philadelphia Semiconductor Index down by more than 4%. The story on CarMax was also troubling. The company's earnings coming in below already reduced expectations. CarMax shares down more than 3.5%. So then you go to the day's economic news. The numbers kind of support this idea that the Fed can tighten more. Personal consumption expenditures, this is the PCE index, excluding food and energy, an increase in Q3 at an annualized rate of 4.7%. That's up slightly from the previous estimate, but it doesn't stop there. First-time jobless claims rose last week, yes, but the numbers were less than forecast. And the final reading on third quarter GDP was revised higher. So you're looking at a two-year yield now that was up 6 basis points on the day to 4.27. In the equity trade, the Dow down 1%, the S&P 500 weaker by nearly 1.5%, the NASDAQ comp falling about 2.2% on the day. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug Krisner, good stuff. We appreciate that. Bloomberg Business Week today is brought to you by Innovation Refunds. See if your small and medium-sized business could be missing out on an opportunity. Was your business impacted by COVID-19 in 2020 or 2021? It may qualify for the Employee Retention Credit. The professionals at Innovation Refunds can help your business recover from the pandemic. See how much could be waiting for your business at getrefunds.com. All right, this is going to be a brutal several days for traveling, and I'm thinking primarily jet travel because we're seeing cancellations across the board as we've got this, weather, impacting a vast majority of the country, and it's coming here to New York as we speak. A lot of people can avoid some of those issues with commercial airlines by flying private. So let's see what's going on in the world of private aviation. Greg Brunson-Pitts, he's the founder and chief executive officer of Advanced Aviation. He joins us via Zoom from Arlington, Virginia. So, Greg, it seems like private aviation really kind of got a big boost from the pandemic as people said, you know what, I don't really want to be in a sardine can with another 150 or 200 people. Maybe now I should start really thinking about private aviation. How have things evolved over the last several years?
Yeah, that's right, Paul. Thanks so much for having me today. The private aviation industry really did get quite a boost from the post-pandemic time. We've definitely seen an uptick, and people really sort of got off the sidelines who were maybe thinking about chartering a plane. Really got into the market and really kind of gave private aviation a look the past year and a half.
And so it got a boost during the pandemic for sure, but talk to us about how private aviation typically fares in a recession. Because when we talk about the consumer all the time, we say luxury cracks last. And when I think about private aviation, I mean, it seems like that is there's no more luxury than you get. So is it kind of removed from the macroeconomic cycles, or what is the typical relationship there?
Yeah, and one point I want to make is that during the pandemic, private aviation and jet aircraft travel really did become an essential tool for people to really move around the country. It was not seen as a luxury item, but more of a tool that people use to get around. In sort of an economic downturn, you do sort of see it sort of separate itself a little bit from the typical cyclical luxury items. People sometimes say that it's the first thing to go, as maybe the company jet. Sometimes people who own a jet maybe will move to charter instead of owning a jet. So yes, our industry sometimes is hit by recessions, just like other luxury items.
Greg, talk to us about the difference between charter flights and membership-based programs.
Sure. So a membership-based program
would require some type of upfront commitment, whether that is a large capital commitment up front or some type of fee associated with it, a number of hours purchased up front, or an annual fee. Advanced Aviation Team, my company, we don't require anything up front. Typically, most of our customers come to us for on a one-off basis, whether that is a one trip or consecutive trips that we can broker on their behalf. So we use market forces to broker planes on behalf of our customers. And that can be over a long term, too. We do a lot of long-term contracts for our customers.
So if most of your customers are coming on that sort of one-off basis, is it safe to assume probably the holiday period is particularly busy for you?
It can be, yes. We do a lot of holiday travel. So business does sort of pick up during this period. Sure.
So, Greg, you've had an interesting background. You started your career in the White House in 2003 under President George W. Bush, eventually becoming the director of the White House Travel Office. And then you were also the provider for the Biden-Harris 2020 campaign with over 1,100 flights. Talk to us about kind of what you learned in the White House in terms of who gets a private jet. What's the criteria? How does that work? Is there protocol there? Do people come begging to you? Did they buy you bottles of scotch to hopefully get a plane?
No. So, director of the White House Travel Office, I manage the charter aircraft that flies in tandem with Air Force One.
Okay.
That carried the White House Press Corps, the Secret Service that did fly on Air Force One, and White House staff. That was typically an airliner charter, so like a 737, an Airbus style aircraft. And then I used some of those skills that I learned at the White House and brought them to the industry. And then we did some of those same things on the Biden campaign and some of the other campaigns that we work for.
So who's your typical customer? Are you working, with political campaigns? Are you working with businesses? Are you working with individuals?
All of the above that you mentioned, Katie. Political campaigns, family offices, touring groups like music groups, book tours, individual families who might want to charter an aircraft. So all of the above. I think we really excel with a group of people who really want to charter an aircraft and need the support of a customized approach. So we're not really looking for economies of scale for matching an aircraft that needs to go from point A to point B and then just get around. We really excel at customizing a solution and working closely with our customers.
All right, let's just say, Greg, I have a family of 6. I want to go skiing out in Aspen.
Sure.
What's kind of the economic break-even commercial versus like a charter?
A charter's always going to cost more. A charter's always going to cost more. I get this question a lot, and the answer is it depends. But a charter is always going to cost more than commercial.
Is there how do people make the economics work? It's just simply an affordability issue, right? I mean, it's just simply if that flight would cost me 10 grand commercial and this is 15 or 20 or whatever, okay, that differential is worth it for me.
Right, and it's very subjective. There are a lot of buckets of information that we put in to come up with a quote for our customers. So, the dates of travel, the size of the aircraft, the experience that our customers want, is it a round trip or is it a one-way, the size of the aircraft. So there are a lot of ways that we can produce a quote or a price for our customers. So it's hard to sort of come up with a price.
All right. Yeah. You might maybe I'll give you a phone call. Greg Brunson, I got some points at United though, so I'm no slouch, Katie. Okay.
There you go.
Greg Brunson Pitts, founder and chief executive officer of Advanced Aviation, joining us on Zoom from Arlington, Virginia. And that was an interesting story at the beginning of the pandemic, kind of the increase in charter service and private jet usages. People just say, I'm not getting on a plane with all these.
Are you kidding me? Breathing in all those particles?
Exactly.
No, thank you.
So we'll see. But that's an interesting part. And we'll see. Hopefully people will get from point A to point B this holiday season.
now 4:53 on Wall Street. I'm Doug Krisner at Bloomberg World Headquarters with a look at some of the company headlines for today. An energy storage company backed by Bill Gates' Breakthrough Energy Ventures is planning a new factory in West Virginia. Construction is expected to begin next year at a cost of around $760 million. Manufacturing is set to begin in 2024. The parent company of TikTok, China's ByteDance, has found some of its employees inappropriately gained access to data on some U.S. users. This is going to complicate efforts by TikTok to convince U.S. lawmakers that the app is secure. A Senate committee is looking at whether automakers are using parts and materials made with forced labor from China's Xinjiang region. Dow Jones saying 8 car manufacturers have been asked to provide the feds detailed information on their supply chains. The earnings today from CarMax came in well below the already reduced expectations. These results deepen concern about weakness in the U.S. used car market. AMC Entertainment wants to convert private equity units into its common shares. AMC is also proposing a reverse 10-to-1 stock split. And Scott Minerd has died. He is was the CIO of Guggenheim Partners, regarded as one of the bond kings over the past few decades. Minerd died yesterday after a heart attack during his regular workout. He was 63 years old. Those are some of the company stories we are following this hour. I'm Doug Krisner at Bloomberg World Headquarters in New York, and this is Bloomberg.
Doug Krisner, thank you so much. Let's go to Wendy Gillette for World
Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Certainly is Bloomberg Business Week. And Katie Greifeld, Paul Sweeney here sitting in for Tim and Carol. Right now, let's go to Wendy Gillette in our 1130 newsroom for World and National News.
Bitterly cold temperatures, heavy ice and snow, and high winds are all going to be Christmas presents from Mother Nature just before the holiday. It's forecasted to be the coldest Christmas in decades in much of the country. Conditions are already treacherous in Washington state, according to this driver.
I've seen 3-4 different crashes. People are just not even paying attention. I saw a Tesla just on autopilot take out 2 cars.
President Biden got a briefing from FEMA and the National Weather Service.
It goes from Oklahoma all the way to Wyoming and Wyoming to Maine, and it's a real consequence. So I encourage everyone, please heed the local warning.
The National Weather Service is calling this storm a once-in-a-generation event. In a year-end news conference, Secretary of State Antony Blinken congratulated Israeli Prime Minister Netanyahu, adding that U.S. diplomacy addresses policies, not personalities. He also reviewed other international issues. Bloomberg's Irv Chapman reports from Washington.
Blinken assailed the Taliban for pulling women out of Afghan universities.
What they've done is to try to sentence Afghan women and girls to a dark future without opportunity. Any prospect the Taliban seeks for improved relations with the international community, which they want and we know that they need, that is not going to happen if they continue on this course.
Blinken defended the decision to end U.S. military involvement in Afghanistan in the knowledge that the Republican-led House plans